start here. Good afternoon to all of you. On behalf of Taxation Committee of BCS, I, along with my co-chairman, Mr. Anil Sathe, and conveners, Hardik, Divya, and Vishesh, I welcome each one of you and thank you all for joining us today. I welcome speaker of this session, Mr. Devendra Jain, and I'm also thankful to him for readily accepting our invitation to take this session. I will first request President of BCS, Mr. Anand Bhatia, to address us and share his thoughts.
Thank you, Deepak Bhai. Good evening, Speaker of the first session, Advocate CA Devendra Jain, Chairman, Co-Chairman of the Tax Committee, Deepak Bhai, Anil Sateji, Conveners Divya and Vishesh, attending BCS members, and other attendees. A warm welcome to each one of you for this very intricate webinar on important landmark decisions in relation to direct tax. As many of you are aware, BCS has been at the forefront of professional learning and knowledge dissemination since last many years. In fact, each month we have been conducting open for all sessions, which are open for anyone to attend without any cost for the last 60 years now, what we call as lecture meetings. Coincidentally, this month we have 4 open for all sessions, which we are conducting in the month of Jan. We had the first one on insolvency and bankruptcy code recent developments, where we had the chairperson of IBBI addressing us. We had the second one where we had a spiritual discourse on facing professional challenges to Bhagavad Gita. We're having the third one today on important landmark judgments on direct tax. And we're having the fourth one on Monday, where the ex-CFO of Washington State from US is coming to address us in person on what we can expect when Trump 2.0 and the impact on India owing to geopolitical changes. I would urge members to make the most of these initiatives at BCS. And today is one such initiative which we have been doing over the last many years, where we try and in the month of Jan evaluate what have been the important rulings in the last calendar year predominantly. And this year, I think the committee felt that we should break it up into 2 parts. One is we talk about the general aspects around decisions. And second is we specifically focus more time and assess and energies on reassessment, which is where I think we have benefit of Advocate CA Devendra Jain to walk us in the first session. So I won't take more time. Over to Deepak Bhai, but once again, a warm welcome to each one of you. The fact that we had more than 600 registrations for today's webinar itself is an indicator of the level of interest that our community has. So Deepak Bhai, over to you. And once again, a warm welcome.
Thank you, Anand. Welcome once again to all the participants. Friends, as tax professionals, we operate in a landscape that is continually shaped by evolving laws and judicial interpretations. And staying abreast of recent decisions is not just a professional responsibility, but a strategic advantage for us. We understand the significant role that judicial pronouncements, particularly from the Supreme Court and High Courts, play in shaping the tax laws. These decisions not only clarify intricate legal provisions, but also set important precedents that guide us in our professional practice by providing insights into the interpretation of the tax statutes. Today, as we discuss some of the impactful tax rulings, we aim to understand their implications, which will guide us in advising clients and navigating the complexities of the tax laws, and will open avenues for effective tax planning and dispute resolution, and to leverage them in one's advisory and compliance roles too. Such webinars gives opportunity to deepen our understanding and sharpen our expertise in this ever-changing domain and adapt to the evolving tax framework. And to fulfill the said objective, we have 2 young and dynamic speakers, Shri Devendra Jain and Shri Ajay Singh, who with their wide experience will take us through the important decisions. Once again, I thank Devendra Jain for being with us today. And before I request him to take his session, I would request Divya to introduce the speaker of the session.
Thank you, Deepak Bhai. I'm very privileged to make an announcement for Devendra Bhai. He has a great professional cadre. Quickly running through, he's been a practicing advocate in direct tax, indirect tax, corporate and allied laws, and he's been a founder of DHJ Legal. He has been appearing in Supreme Court, High Court, and Tribunal. Before that, he was practicing as a chartered accountant for 19 years. He was a proprietor in his own firm, DH Jain and Associates. He has been co-author of books on ICDS, recovery of taxes, budget publications, and Section 56(2)(10) by various organizations for CAs and lawyers. He has also got a Best Lecture Award from the Sales Tax Practitioner Association in the year 2014 for impact of Hawala purchases on income tax assessments. He has been a paper writer for a lot of years for RRC, specifically for CTC, BCS, LCAs, and so on. He has been a past chairman of the Direct Tax Committee and a managing council member of the Chamber of Tax Consultants. And he has also been a faculty on various certificate courses and webcast. We are happy to have you here, Devendra, and welcome to BCS. And the floor is yours for the session ahead. Thank you so much.
Thank you, Divyaji, for the nice introduction. Respected President of BCS, Anand Bhatia. Respected Chairman of the Tax Committee, Direct Tax Committee, Deep Bhai. Past President Anil Sate, sir. Conveners Divya, Vishesh, seniors in profession, all participants, fellow professionals, ladies and gentlemen, very good afternoon to you all. At the outset, let me thank the Bombay Chartered Accountant Society and the Taxation Committee for giving me this opportunity to speak on the recent developments in the judicial area of one of the very prominent area of practice, income tax, of reopening. In the year 2021, when we are in the mid of the difficult period of everyone's life because of COVID lockdown scenario, the Finance Act 2021 made a radical shift in the process of reopening, and the explanatory memorandum
Devendra,
of that
sorry to
amendment
interrupt.
suggested.
Devendra,
Yes, sir. Yes, sir.
Your voice is breaking in between. So I think there is some network issue, or can you just say, because
Should I stop my video and try?
I don't know, but
There may be a
yeah, and you can start screen sharing also whenever you want. And
Okay. Let me try some
yeah,
time without the video.
yeah, okay.
So I was saying that in the year 2021, the whole scheme of reopening of assessment was changed by the Finance Act 2021, Section 147, 148, 149, 151, all substituted by new sections, and one new section introduced, 148A. We are in 2025. In this 4 years period, it is a kind of a disturbing thing that the professed objective of reducing litigation by these substituted provisions of reopening, at least in this initial period of 4 years, has not achieved the objective. And in fact, the very provision which has been introduced to reduce litigation has been challenged across the country and has added to so much pressure on the judiciary. Basically, this all dispute started because of one enactment, which we popularly call as TOLA, Taxation and Other Laws Amendment and Relaxation Provision, initially introduced as an ordinance and then became an act. So in the lockdown period, when the entire country was on a standstill, TOLA was introduced to relax certain provisions of the act and to extend certain deadlines. The topic for our discussion is reopening under the Income Tax Act. And under the old regime, the maximum period of reopening was 6 years from the end of the assessment year. The new regime substituted provision of reopening was effective on 1st of April 2021. However, under the old regime, when the lockdown was announced, TOLA had introduced a provision to relax the deadline for compliance of various actions, which included the actions for issue of notice under Section 148, etc. And the actions which were notices which were to be issued by 31st of March 2020, and then next year in the extended lockdown regime by 31st of March 2021. These deadlines were extended by various notifications issued under the TOLA from time to time. And the last extension was till 30th of June 2021. And therefore, there was an overlapping period of 3 months, the first quarter of financial year 21-22, that is April, May, and June 21, where though the substitutory provision had come into force, but the notices were being issued under the old regime. So large number of writ petitions were filed across the nation, challenging this action of the department to introduce reopening notice in the old regime after 1st of April 2021. Deepak sir, now the voice is better?
Yeah, voice is better, but Devendra would request, first of all, means you can start your screen sharing. And
Yes, yes.
I think if video also you can start now, let us see, because I think.
Screen is visible now?
Yes, you can do full screen and your video also you can, yeah, that would be better, yeah.
So I was trying to explain the background of the very first judgment for discussion, Union of India versus Rajeev Bansal. So in the overlapping period of April to June 21, when notices were issued in the old regime, though the new regime had set into motion from 1st of April 2021, and several writ petitions filed across the country. Unanimously, all the high courts, except Chhattisgarh High Court, accepted the plea of the assessee that once 1st April 2021, the new regime had come into force, the earlier extension of TOLA cannot prevail, and therefore all the notices issued in the first quarter of 2021 in the old regime are bad in law. From Allahabad High Court in the judgment of Ashish Agarwal, matter reached to Supreme Court, and in the judgment of Ashish Agarwal, Supreme Court, by exercising their power under Section 142, accepting the position that all the high courts had correctly said that these notices are bad in law, but to save the leakage of revenue in a large number of cases, Supreme Court exercised special power under Article 142 and said that the notices which are issued under Section 148 of the old regime be considered as notices under Section 148A, Clause B of the new regime. While exercising these powers, in the judgment of Ashish Agarwal, Supreme Court also said that all the defenses to the SSE, including the defense under Section 149, will be open. In the substituted regime of reopening, Section 149, which lays down the timeline for reopening, under the old regime, the timeline was 4 years and 6 years maximum. In the new regime, the timeline is generally 3 years and extended timeline up to 10 years, subject to fulfillment of certain additional conditions. However, the first proviso to Section 149 says that if a notice is time barred under the old regime for any period prior to assessment year 21-22, if the notice is already time barred under the old regime, then it cannot be issued under the new regime. So even though the maximum time period under the new law is 10 years, there is a saving that if it is time barred under the old law, it will be time barred under the new law also. So after the judgment of Ashish Agarwal on 4th of May 2022, assessing officer shared the material with the SSE. SSE was to respond to that, and on that basis, a fresh order under Section 148 AD was passed. Before various high court, challenging the notices generally in the month of August 2022, after the Ashish Agarwal judgment, was that whether these notices are time barred under the first proviso to Section 149. Because as per the first proviso to Section 149, notices time barred under the old law would be time barred even under the new law. Now 1314 under the old law, maximum 6 years period is 31st of March 2020. For 1415, it will be 31st of March 2021. With TOLA extension, it could go up to 30th of June 21. But the challenge of the SSE was that after 1st of April 21, TOLA extension cannot be read into the old law. And therefore, again, a series of petition challenging these notices was filed in various high courts. Apart from that, assessment year 16-17 and 17-18, there was a peculiar challenge before various high court about the sanctioning authority under Section 151. Finally, this again, majority of the high courts except ruled in favor of the SSE. Even in the second round, including Bombay High Court, ruled in favor of the SSE that these notices issued in July and August 22 are time barred. So the matter again reached to Supreme Court in the judgment of Rajeev Bansal. Rajeev Bansal judgment covers 5 different assessment years. Assessment year 13, 14, 15, 15, 16, 17 and 17, 18. Three different groups, 13, 14 and 14, 15 a different thinking applies. 15, 16 there is a different line of thinking, and 16, 17, 17. So as far as the first is concerned, assessment year 14 and 14, 15. The dispute was basically that there is a notice which was issued between April to June 2021, which after the judgment of Ashish Agarwal was to be considered as notice and
Devendra, we have lost you.
Huh?
We have lost you. Something.
Was lost in between.
Yes, Devendra,
Am I
you
audible now?
Yeah, now you are audible. Yes.
Yeah. You can start your screen sharing and switch off your video. That might help.
Yes, I'll again switch off my video. Screen is visible.
Yes. No, not yet.
I started the screen sharing.
Can't see.
Screen is not visible, Devendra.
Stop screen sharing and restart it.
Okay.
Now,
Not yet.
and visible now.
No. Screen is not visible.
Sir, I think you've shared the wrong screen on the screen.
I restarted
to
again
share the-
screen sharing.
We can see your screen, but
My
the
app
PPT is
is
not visible.
showing.
Yeah, now
can see
screen
it
is
now.
there. Devendra?
Yeah. I think he's trying to.
Yes, we can see the screen now.
Oh,
I switched to another data mode. Hopefully, it should be better now.
yes, we can see the screen now.
So, in the Rajeev Bansal judgment of Supreme Court,
Can you
it
share
can
your
basically.
video? Can you the video also can be?
No, I think Deepak, if the
I will try again.
Acha, okay. But the screen,
we can see the screen.
So, in the judgment of Rajeev Bansal, basically it can be divided into three bunch of years. One bunch is assessment year 13-14 and 14-15. Here the issue is of limitation under the first proviso to section 149. And here Supreme Court in the judgment of Rajeev Bansal, finally balancing all the arguments of the assessee as well as revenue, carved out a new concept of surviving period. And it also, with the help of certain examples in the judgment, Supreme Court explained the concept of surviving period and held that if notices issued between 1st of April 21 and 30th of June 21, if they were issued within the surviving period, then they are valid in law. If they are issued beyond the limitation of surviving period, they will be bad in law. To understand this concept of surviving period, let us understand first the background. The notices are issued between April 21 to June 21. Supreme Court judgment of Ashish Agarwal came on 4th of May 2022. Supreme Court directed two things. It directed the revenue to provide material to the assessee within 1 month. And it also said that assessee may file objection within 2 weeks thereafter. The notices which were originally issued under Section 148 were to be treated as notices under Section 148 AB. Assessee filed response to those notices. Some assessees did not file response to those notices, and ultimately order under the new regime, Section 148 AD, were passed and notices were issued under Section 148. And predominantly in all these cases, the notices are issued majorly in July 2022 and in some cases in August 2022. Now for the surviving period, Supreme Court tried to explain the third proviso to Section 149. And in fact, basically this concept of surviving period is really built on the first foundation that assessee's argument that TOLA will not apply after 1st of April 2021. This was not accepted by Supreme Court. And Supreme Court said that the last extension given by TOLA till 30th of June 2021 was also a valid extension, but balancing the rights and contentions of both the parties, peculiarly in view of the guidelines laid down by Supreme Court in Ashish Agarwal judgment. And also reading third proviso to Section 149. This concept of surviving period is coined by the Honorable Supreme Court. So first of all, the third proviso to Section 149 provides that while calculating the period of limitation, the time allowed to assessee under Section 148 AB is to be excluded, and the period during which the proceeding under Section 148A are stayed by an order or injunction of any court is also to be excluded. These two are the exclusions provided in the third proviso to Section 149. The original notice under Section 148 is now to be treated as a notice under Section 148 AB. However, this deeming fiction came into picture on 4th of May 2022 when the judgment in case of Ashish Agarwal was pronounced. So between the period of actual date of notice and 4th of May 2022, naturally the assessing officer could not have acted treating this notice as a notice under Section 148A, because till that period, assessing officer was considering these notices to be a valid notice under the old regime and they were proceeding under the old regime. On 4th of May 2022, the date on which Ashish Agarwal judgment was pronounced, these notices were considered to be a notice under Section 148 AB. Now, if we read Section 148A, the time provided to assessee to respond to this notice is generally a period of 1 month, which on an application can be extended by the assessing officer. So if a notice was issued in the month of April 21 under Section 148, which if now to be treated as a notice under section 148 AB, the time for the assessee to file response has already expired by the time the Ashish Agarwal judgment was pronounced on 4th of May 2022. And therefore, Supreme Court read that when the third proviso says that the period during which the proceeding under 148A are stayed by an order or injunction of any court is to be excluded, Supreme Court explained that these show cause notices were deemed to have been stayed by the order of apex court from the date of their issuance till the date of assessee to respond to the show cause notice, and therefore this period should be excluded for computing the period of limitation. Therefore, exclusion is number one, the time during which the show cause notice were effectively stayed, that is from the date of issuance in the first quarter of 21 till the supply of relevant information or material by the assessing officer in terms of the directions in Ashish Agarwal, and thereafter a period of 2 weeks allowed to the assessee to respond to the show cause notice, again in terms of the directions
उसके बाद पहले
in Ashish Agarwal.
रिसीव देगा ना देना है वो लिखना ऐसा रिसीव देगा ना ओरिजिनल
I think there is some disturbance again.
No, you continue. You continue, Devendra. Your screen has gone off. Okay. Now he's back on.
So, the date of actual notice in the first quarter of 21 till the judgment of Ashish Agarwal, a 1 month period thereafter for supply of information to the assessee, and a 2 weeks period allowed to the assessee to respond to that show cause notice. All this period to be excluded while considering the period of limitation. Then Supreme Court said that under the old regime, the maximum extension granted by TOLA was till 30th of June 2021. As per Ashish Agarwal, if the earlier notice is to be considered as a notice under 148 AB, then to take it to a logical conclusion, the entire proceeding is now to be concluded under section 148A, culminating into an order under section 148 AD, and then again a notice under section 148. And all this was to be done till 30th of June 2021. Now, naturally, because Ashish Agarwal judgment itself had come on 4th of May 2022, it is impossible that all these actions are completed under the new regime by 30th of June 2021. And there, the third proviso to section 149 steps into to exclude the intervening period from the date of notice till the date of judgment in case of Ashish Agarwal. Secondly, from the date of judgment of Ashish Agarwal till the time of supply of information and material to the assessee. And thirdly, 2 weeks period allowed to the assessee to respond to that notice after the supply of material. After exclusion of all these periods, the assessing officer has to pass the order under section 148 AD and issue notice under section 148. And this action has to be completed before 30th of June 2021, but reading in the 3 exclusions which I explained just now. Meaning thereby, you have to first count the number of days between the deemed notice and 30th of June 2021. So if your notice under section 148 was issued on any day between April, May and June 2021, from that date till 30th of June, what is the balance period? That balance period was available for the assessing officer to complete 3 tasks. Number 1, consider the reply of the assessee. Then to take a decision under section 148 AD. And third, to issue the notice under section 148. So the limitation period for the assessing officer to issue the fresh notice under section 148 would be the date of filing response by the assessee plus the days of surviving period. Because still the assessee files a response to the notice under section 148AB, the exclusion of third proviso to section 149 operates. You can understand this with the help of an example. If a notice under section 148 is issued originally on 1st of May 2021 for assessment year 14-15, as per TOLA, the maximum time to complete all the formalities was till 30th of June 21. So the number of days between the actual date of issue of notice under the old law, 1st of May 21, and the last date as per TOLA, 30th of June 21 is 61 days. 31 days of May and 30 days of June. After accounting for all the exclusions as per the third proviso to section 149, AO will have surviving period of 61 days to take a decision under and pass an order under section 148AD of the new regime and issue the notice under section 148. So in this example, when 4th of May 2022, the judgment of Ashish Agarwal was announced, 30 days period was given to the assessing officer to supply information and material to the assessing. And thereafter, there was a period of 2 weeks given to the assessee to respond to notice. So for example, assessing officer in this case gives the material to the assessee on 4th of June 2022. That is within 1 month period given by Ashish Agarwal judgment. So from 4th of June 2022, assessee had a time to submit response within 2 weeks, that is 18th of June 22. From this 18th of June 22 till 18th of June 22, the exclusion under section 1, third proviso to section 149 operates. That means from, and there are 3 parts of this exclusion. From 1st of May 21 till 4th of May 22, notices are deemed to be stayed because Ashish Agarwal judgment itself pronounced on 4th of May 22. Second leg of exclusion is 1 month period for the AO to furnish information and material to the assessee. So from 4th of May to 4th of June 22, second leg of the exclusion, then 2 weeks period to the assessee to reply to that notice. So 4th June 22 to 18th of June 22, third leg of the exclusion under third proviso to 149. So till 18th of June 22, there was exclusion as per section third proviso to section 149. So if the period from 1st of May 21 till 18th of June 22 is to be excluded, it simply in other words would mean that 18th of June 22 should be considered as if it was a date of the notice under 148, that is 1st of May 21. If all this dispute had not arose, then on 1st of May 21, the balance period available to the assessing officer in TOLA was 61 days, that is 1st of May 21 to 30th of June 21. This 61 days period should be available to AO now after 18th of June 22. Because assessing officer hands were tied up till 18th of June 22, he could not have proceeded under section 148A, and therefore the same period which would have otherwise available to the officer in TOLA till 30th of June 21 is 61 days. This 61 days should be added to 18th of June, which comes to 18th of August 22. 18th June 22 plus 61 days, 18th of August 22. So if the notice under the new regime is issued up to 18th of August 22, it will be a valid notice as per the judgment of Rajeev Bansal. If the notice is issued after 18th of August 22, it will be time barred. So I tried to elaborately explain 3 types of exclusions provided in the third proviso to section 149. To explain this concept of surviving period, which becomes quite confusing Now we'll put this in very simple terms, a simple mathematical formula to consider whether our notice is valid or invalid. Is count the number of days between the actual date of notice and 30th of June 21. So in this example, the actual date of notice was 1st of May 21. So count the number of days from 1st May 21 to 30th of June 21 is 61 days. Now, after the Ashish Agarwal judgment, when the assessee filed his response to the 148 AB deemed notice, from that date, add these 61 days. So in this example, when assessee has submitted response on 18th of June, add 61 days to this. If we slightly change this, that instead of notice under section 148 being issued on 1st of May 21, instead of 1st of May 21, if we consider that the notice was issued on 1st of June 21. So under the TOLA, the number of days remaining with the officer were 30 days. 1st of June 21 to 30th of June 21, 30 days. Simply add this balance period of 30 days to the date of assessee's response post Ashish Agarwal. In the same example, where the assessee's response was 18th of June 22, if we add 30 days, it will come to 18th of July 22. So 18th of July 22 would be the maximum deadline for issuing notice under the new regime. If the notice is issued till 18th of July 22, it will be a valid notice. If it is issued beyond that, it will be an invalid notice. So the simple formula is two things. Number one, calculate the number of days between the actual date of issue of notice under the old regime till 30th of June 21. Whatever this period comes, simply add this number of days to the date of assessee submitting response to 148 AB. That will be the final deadline for issue of notice post Ashish Agarwal judgment. Of course, the standard formula will apply in a standard case. There will be various ifs and buts in this formula. A situation where the assessing officer has not at all provided the relevant material to the assessee. That could be one variation. Second variation is where assessee has not at all responded to that notice after receipt of material. Third variation could be that where assessee has responded, but responded prior to the 2 weeks period. Then whether third proviso to 149 exclusion should operate for 2 weeks period given by Ashish Agarwal to reply to the assessee, or whether it should apply only till the date of actual response submitted by the assessee. These are certain small variations which will have to be argued in different cases. But overall, balancing the rights, Supreme Court given a very simple formula. Officer had to complete all the action even under the new law by 30th of June 21. But because this concept of treating this old notice as a notice under the new regime itself originated on 4th of May 22, therefore, the third proviso to section 149 from the actual date of notice till the date assessee submit the response, all this period is to be excluded, and therefore the balance days till 30th of June to be added to the date of assessee's response to notice under 148 AB. And in a large number of cases, the notices in the old regime are issued on 31st of May 29th of June 21 or say 30th of June 21. In that case, the balance period under TOLA was only 1 or 2 days. If it was 29th June, it will be 2 days. If it is 30th of June, it will be 1 day. That means immediately after receipt of response by the assessing officer, post Ashish Agarwal judgment, in that balance 1 or 2 days, officer had to pass order under section 148 AD. However, there could be one line of argument here that section 148A also provides in the sixth proviso that if this balance period is less than 7 days, then it will be extended up to 7 days.
It may maximum be extended to 7 days, and therefore from the date of response by the assessee post Ashish Agarwal judgment, maximum 7 days would be available to the assessing officer to pass the order under section 148 AD and the final notice under section 148. So for assessment year 13, 14 and 14, 15, 6 years period as specified in section 149, expired between after April 1, 21 and expired on 31st March 20 and 31st March 21 respectively. Therefore, 13, 14 and 14, 15 TOLA will be applicable. Notices originally issued, that is deemed notices, are within time if the reassessment notices issued under new regime are issued within the time limit surviving under the Income Tax Act, read with TOLA after considering the 3 exclusions provided in the third proviso to section 149. Now, before going to the second and third batch of years in Rajeev Bansal, because this surviving period concept is a little bit confusing. If there are any questions on this, I think it will be better I answer it right now only, or whatever the committee decides. Should I take up the questions right now only on surviving period?
Yeah, I don't.
I think Devendra, you continue.
Okay.
So that let's because 13, 14, 14, 15, I understand the complication. Let's go through the other 3 years. So
Okay. So the second batch of petitions in Rajeev Bansal was assessment year 15, 16, which is the simplest to understand. Without the application of TOLA, the time limit for 15, 16 under the new regime 3 years period on March 19, under the old regime 6 years period on March 22. Now the whole focus of TOLA was to provide relaxation of the time limit which fell for completion or compliance between 20th of March 2020 to 31st of March 21. So 15, 16 was the year where neither the time limit was expiring under the old law nor the time limit was expiring under the new law between these two cutoff date of 20th of March 20 and 31st of March 2021. And therefore, as held by even Bombay High Court in case of Exaware, now reaffirmed in Rajeev Bansal, and in fact, department itself has considered before the Supreme Court that TOLA cannot apply to assessment year 15, 16 because neither under applying the new law nor applying the old law, the compliance action did not fall between the TOLA compliance window of March 2020 to March 21. So if TOLA does not apply to 15, 16, the implication would be this, that from 1st of April 2021, the new law is set into motion and therefore the notice should have been issued only under the new law. Notice could not have been issued under the old law. And secondly, post Ashish Agarwal judgment, when the notices are issued in the month of July and August 22, the concept of surviving period which we tried to discuss in last half an hour will not apply to 15, 16 because TOLA itself did not apply to assessment year 15, 16 and therefore there is no question of counting the number of days remaining for the officer between the actual old 148 notice and 30th of June 21. The revenue in the submission before the Supreme Court itself considered that all the notices issued for assessment year 15, 16 on or after 1st April 21 will have to be drawn. In fact, recently Delhi High Court 2 weeks earlier in the IBBO Group Private Limited case applied Rajeev Bansal in case of assessment year 15, 16 and quashed the notice which was dated 23rd of July 20. So 15-16 is simplest. Now we move to the third batch of years, assessment year 16-17 and 17-18. Now here also, as far as the limitation for issue of notice is concerned, TOLA will not come into picture because 16-17 and 17-18 also, the limitation under the old law, which is saved by the first provided to section 149, the 6-year period did not expire when the notices were issued under the old regime. However, the peculiar situation here is of sanction. For a notice to be issued under section 148, a sanction of specified authority is required to be taken under section 151. In the amended regime, section 151 provides two layers of sanction. If notice is issued within 3 years from the end of the assessment year, then 151 clause 1 applies. If the notice is issued beyond 3 years from the end of the assessment year, then 151 clause 2 applies. The specified authorities in clause 1 and clause 2 of section 151 are different. Under clause 1, sanction can be taken of principal commissioner of income tax, whereas beyond 3 years under clause 2, sanction has to be taken of principal chief commissioner of income tax. The question was, the notices which were issued between April 21 to 30th of June 21 under the old regime, which are now treated as a notice under section 148AB after Ashish Agarwal judgment, which ultimately has to culminate into an order under section 148AD and a notice under section 148, and the fresh notice under section 148, which is issued in the month of July 22 or August 22, whether it should be considered as within 3 years so as to require sanction under 151(1), or should be considered as beyond 3 years to require sanction under 151(2). Now, the instruction which was issued after Ashish Agarwal judgment, department had taken a position that all these notices which are issued in the first quarter of 21 will go back to the original date on which these notices ought to have been issued, and therefore all these notices ought to have been considered as being issued within 3 years period, and therefore sanction was taken under section 151(1). But in Rajeev Bansal case, as also previously all the high courts unanimously held that this travel back theory will not apply, and therefore CBDT circular dated 11th May 22 deeming these notices to be issued within 3 years and therefore properly sanctioned by principal CIT was not accepted by Bombay High Court in case of Siemens and Rajeev Bansal. Supreme Court explained it also in terms of TOLA, that for example, the 3 years limit for assessment year 17-18, it fell for completion on 31st March 21. Now, this date of 31st March 21 falls between the TOLA compliance window of 20th of March 2020 and 31st March 21, and therefore TOLA would apply to this even for the purpose of sanction. However, TOLA will operate only till 30th of June 21, and therefore authority specified under section 151(1) can grant sanction till 30th of June 21. I'll repeat it once again. If your assessment year is 17-18, if sanction is to be taken under 151(1) of the new regime, then 3 years period will expire on 31st March 21, because this 31st March 21 fell between the TOLA window of March 20 to March 21. It can be extended till 30th of June 21, and therefore if sanction is given till 30th of June 21 by an authority specified under section 151(1), it will be valid. However, in majority of the notices issued under section 148 for assessment year 16-17 and 17-18, post Ashish Agarwal, revenue has obtained sanction of authority specified in section 151(1), relying on circular dated 11th of May post Ashish Agarwal. In Rajeev Bansal case, Supreme Court held that approval in these years in June or July or August 22 was beyond a period of 3 years, even applying TOLA, and therefore sanction has to be obtained under section 151(2), that is from Principal Chief Commissioner or other parallel authorities specified in 151(2). Since this has not been done, notices issued in July 22 for assessment year 16, 17 and 17, 18 with a sanction under 151(1) are invalid notices, because sanction ought to have been obtained under 151(2). So these are the three different groups of years in Rajeev Bansal case. 13, 14 and 14, 15. The concept of surviving period is to be seen. 15, 16, department itself has conceded TOLA will not apply, and therefore all notices issued after 1st June 21 are bad in law for assessment year 15, 16. 16, 17 and 17, 18, question of limitation is not applicable, but the question of sanction is relevant. If sanction is taken under section 151(2), 16, 17, 17, 18 notices would be valid. If sanction is taken under 151(1), 16, 17, 17, 18 notices are also bad in law. One more important aspect in Rajeev Bansal case was, what is the effect of Ashish Agarwal judgment? Whether it will apply to all the approximately 90,000 notices issued between April 21 and June 21, or it should apply only to those cases where a writ petition was filed in the first round. The confusion was because at several places in the judgment of Ashish Agarwal, Supreme Court had used the word that the present order shall be applicable pan-India. However, in the operative part of direction, it was said that it will apply to, first of all, the judgment and order passed by High Court at Allahabad, because that was the lead matter before Supreme Court, Ashish Agarwal judgment. Secondly, it said all judgment orders passed by different High Courts were noticed under the old regime, were a challenge before the High Court and set aside. And thirdly, where the notices were challenged before the High Court, but those writ petitions are pending. However, because in several parts of Ashish Agarwal judgment, it was written that it shall apply to pan-India, because various assessees had taken also one stand that if in the first round, I have not filed any writ petition, I have not challenged the notice issued between April and June 21, then the judgment of Ashish Agarwal does not apply to me. And therefore, in any case, the new notice issued under section 148 was time barred because it was done under the new law applying Ashish Agarwal. And if I have not filed a writ petition, Ashish Agarwal judgment did not apply to me. In Rajeev Bansal judgment, Supreme Court clarified that the directions in Ashish Agarwal will extend to all the 90,000 reassessment notices issued under the old regime between April 21 and June 21, irrespective of whether a writ petition was filed, whether it was pending, whether it was disposed, whether no writ petition was filed. So all the notices issued between April 21 and June 21, Ashish Agarwal judgment will apply. After the judgment of Rajeev Bansal, I have listed certain tribunal decisions applying the judgment of Rajeev Bansal and quashing the reassessment notices. Bombay Tribunal in Surya Ferro Allies and Satish Sethi for assessment year 17-18, in Manish Financial for assessment year 16-17, Raipur Tribunal in Keshri Rice Industries assessment year 16-17 has quashed the reopening notices on the ground of sanction. Manish Financial also assessment year 15-16, so relying on the Attorney General statement before the Honorable Supreme Court in Rajeev Bansal, 15-16 quashed. The last judgment, Pushpak Realties, with due respect to the tribunal, is deviating from the ratio of Rajeev Bansal, at least as far as assessment year 13, 14 and 14, 15 is concerned. It as though in an ex parte order quashed the reopening notice in favor of the assessee, but it has not applied the concept of surviving period as coined by Supreme Court in case of Rajeev Bansal. I could not trace any tribunal decision post Rajeev Bansal on the concept of surviving period for assessment year 13, 14 and 14. So now moving forward from the Rajeev Bansal judgment. Recent Bombay High Court judgment, Hexaware Technologies. I need not spend much time on this because this is a talk of town. Everyone practicing in income tax is aware of this judgment. The basic controversy was about who should issue the notice under section 148, whether it should be issued by the jurisdictional assessing officer or whether it should be issued by the faceless assessing officer. Section 151A, which has been introduced, and giving effect to that section 151A, the instruction issued on 29th of March 2022, the department has taken a stand that till the stage of issuing notice under section 148, the jurisdictional assessing officer will take out the proceeding, and once 148 notice is issued, it will move to the faceless assessing officer. Honorable Bombay High Court in case of Hexaware has not accepted this contention of the department and held that the notices under section 148 as well as proceeding under section 148A also ought to have been conducted by faceless assessing officer in view of the provisions of section 151A, read with the 29th March 2022 circular. Of course, this is now pending before Honorable Supreme Court. It is scheduled to be listed on 28th of January, that is the coming Tuesday. So let us see what is the outcome of this. But apart from this particular issue of 151A, there are several other issues also decided in Hexaware. But of course, in Hexaware judgment, the assessment year involved is 15-16. So even prior to Rajeev Bansal, Bombay High Court in Hexaware has held that for 15-16, TOLA cannot apply, and therefore notice dated 27th of August 22 is bad in law. Now it is department also considered before Supreme Court. So this particular stand taken by Bombay High Court in Hexaware gets affirmed in Rajeev Bansal. Second important aspect, notice issued without document identification number. That is also bad in law in terms of the circular number 19 of 2019, where DIN is mandatory, and then separate intimation letter giving document identification number is not in accordance with the procedure prescribed in circular number 19 of 2019. Even this issue, in fact, is pending before the Supreme Court, but it is not in the it's a separate batch of petitions, matter arising from Delhi High Court. Notice has already been issued. Delhi High Court judgment has been stayed by Supreme Court, where the issue of 151A is there. 28th January, where Hexaware is also listed before Supreme Court. There also one of the issues is DIN. But the lead issue in all these petitions listed on 28th of January is about section 151A. Moving forward, another judgment of Bombay High Court in Ganesh Nivritti Jagtap. As far as Hexaware judgment in 151A is concerned, that even the proceeding under section 148A and the notice under section 148 should be issued by faceless assessing officer. However, even under section 144B, there are two categories of cases which are kept out of faceless regime. One is international tax and second is central charges. That is where, in view of the search proceeding, the assessment is in central charge. These two are the exceptions carved out in 144B. So after the Exaware judgment, department argued that at least in international tax charge and central charges, notices could be issued by jurisdictional assessing officer. Bombay High Court in case Ganesh Nivritti Jagtap did not accept this argument of department and held that even in case of central charges as well as international tax charge, the notice under section 148 as well as proceeding under section 148AB has to be done by the faceless assessing officer only. The exception under 144B is only for the conduct of completion of assessment. So post issue of section 148, the actual conduct of assessment can be done by the jurisdictional assessing officer under section 144B for central charge and international tax cases. That is the ruling of Bombay High Court in Ganesh Nivritti Jagtap, also placing reliance on another judgment in Abhin Anil Kumar Shah for international tax charge. Abhin Anil Kumar Shah was the exception of international tax and Ganesh Nivritti Jagtap was the exception for the central charges. So as far as today's position is concerned, Bombay High Court has held that whether it is central charge, whether it is international tax, or whether it's even the general proceeding, all 148 notices have to be issued by the faceless assessing officer only. These are issued by jurisdictional assessing officer, they are bad in law. A large number of notices already quashed by Bombay High Court, also several other high courts. However, later on Bombay High Court itself realized that in all these cases, department is filing SLP. It may burden very small assesses also. And therefore, Bombay High Court subsequently in JD Printer's case took a decision that till the matter of section 151 is decided by Supreme Court, the notices will not be quashed by Bombay High Court. Bombay High Court is only granting stay on those proceedings till the final outcome comes from the Supreme Court on 151A issues. Under judgment again of Bombay High Court, Vodafone Idea Limited. This is also very interesting judgment, peculiar to assessment year 1890. Now, as discussed earlier, under the new regime, sanction under section 151 is bifurcated into two categories. Within 3 years, 151 clause 1 applies. Beyond 3 years, 151 clause 2 applies. Under the law of 148A, firstly, the assessing officer has to issue a show cause notice under 148A clause B. Assessee will reply. Considering the assessee reply, assessing officer passes an order under section 148AD that it's a fit case to issue 148 notice and then simultaneously issues a notice under section 148. 3 years period for assessment year 1819 would expire on 31st of March 2022. So this was a case where 148AB notice was issued in March 22. However, considering the assessee's reply, 148AD notice was issued on 7th of April 22. So if we consider this time period of 7th of April 22, this is beyond a period of 3 years. However, sanction was obtained for Principal Commissioner of Income Tax. That is under 151 clause 1. Assessee challenged that because the notice ultimately is issued on 7th of April 22, which is beyond a period of 3 years, sanction should be obtained from Principal Chief Commissioner under 151 clause 2. And the argument of the assessing officer was that, the argument of the department is that, though 148 notice is issued on 7th of April 22, the show cause notice for the same, that is 148AB, is already issued in the month of March 22, which is within a period of 3 years, and therefore sanction currently obtained under 151 clause 1. Honorable Bombay High Court does not accept this argument and held that Sanction is for the purpose of notice under section 148. Once it is beyond a period of 3 years, sanctioning authority should have been Principal Chief Commissioner under 151(2). Why I said this is a situation peculiar to assessment year 18-19? Because later on, Finance Act 2023, department realized this mistake, probably, government realized this mistake, and they inserted a proviso in section 151 with effect from 1st of April 23 that the time given to the assessee to respond to 148 AB notice is to be excluded even for the purpose of section 151. This exclusion is already there in the limitation period under section 149. But prior to Finance Act 23 amendment, this exclusion was not there in section 151. So Bombay High Court also considered this, that this exclusion which has been inserted with effect from 1st of April 23, in the present case, because the notice is issued on 7th of April 22, this amendment is not applicable, and therefore assessment year 18-19 notices. If notice is ultimately issued in the month of April 22, it will be beyond a period of 3 years, and therefore sanction should have been under 151 clause 2. As far as assessment year 19-20 onwards is concerned, even if we take 19-20, 3 years period would expire on March 23. So if 148 AB notice is issued in March 23 and 148 notice is ultimately issued in April 23, though that April 23 would be beyond a period of 3 years, but because of the proviso to section 151, which is with effect from 1st of April 23, this period would be excluded, and therefore even April 23 notices would be considered as notice within a period of 3 years, and 151 sanction would be needed. But 18-19 was not covered by this amendment because notices already issued in the month of April 22. Law is to be seen as on the date of issue of the notice. This amendment is with effect from April 23, and therefore it cannot cover April 22 notices. Next judgment of Karnataka High Court in case of Vasanta Ramdas Pai versus ITO. It explains the concept of information. The whole shift of Finance Act 21 from the old law of reopening to the new law of reopening is the shift of the subjective approach of reasons to believe that income has escaped assessment to an objective approach of an information suggesting escapement of income. In the old regime, AO had to record his reasons why he believes that income has escaped assessment. Under the new regime, AO need not record any reason, but there he should be in possession of an information which suggests escapement of income. This information has been defined in explanation 1 to section 148, and in this judgment, Karnataka High Court explained this concept of information, saying that under the new law is more stricter than the earlier law. The expression information would mean instruction or knowledge derived from an external source concerning facts or particulars, or as to law relating to a matter bearing the assessment. So the post-amendment, escapement has to be established with concrete information. In the facts of the case, the 148 AB notice merely mentioned that shares were allotted in company as a consequence of demerger of section 56(2)(c) 2018 ought to have been offered the same to tax. Only this much information was given in 148 AB. On an examination of the return filed by the assessee, it was seen that this transaction was not offered to income tax under section 56(2)(10). However, there was further explanation in 148 AB notice as to how 56(2)(10)(c) would apply to this particular transaction. Karnataka High Court's assessing officer cannot employ jugglery of words in notices of this kind and let the assessee keep guessing why his assessment is being reopened. It held that the information appearing in explanation 1 cannot include the return of income filed by the assessee, as it doesn't fall within any of the 5 categories specified in the explanation 1 to section 148. If based on the return, assessing officer wants to take some position, then correct course of action is to undertake a regular assessment under section 143. If that time has already lapsed, he cannot use the provisions of reopening to take a case for scrutiny, merely relying on the information which is reflected in the return itself. Court also said that in 148 AB noticing the facts of the case was not very clear, but in 148 AD, assessing officer had given various reasons, but court held that order to be passed under 148 AD cannot transcend the scope of proposal notice under 148 AB, in as much as such a notice happens to be the foundation on the basis of which such an order can be passed and not otherwise. Therefore, definitive conclusions as to the grounds that are not indicated in the proposal notice cannot be said to be in line with the scheme and purpose of section 148A. Next, decision of Chhattisgarh High Court in case of US Associates is also a very common situation where 148AB notice makes one particular allegation. However, in the final order under 148 AD, some new allegation is done based on various Supreme Court judgments. Chhattisgarh High Court held that the order under 148 AD cannot travel beyond the show cause notice issued under 148 AB. Only the issues for which SCN is issued under 148 AB can be subject matter of order under section 148 AD. Next, decision of Bombay High Court in case of Karthik Gandhi. In this case, assessee's primary challenge was that the sanction given by the authority under section 151 as well as the order passed by assessing officer under 148 AD was with non-application of mind. Assessee had given some donation to a charitable trust of rupees 5 lakhs, on which it had claimed 50% deduction under section 80G. Based on certain third-party statement, there was an allegation that this is a bonus donation, but in the form of approval, the quantum of escaped income was mentioned as rupees 5 lakhs. The court came down very heavily, saying that if the deduction claimed was only 15% of rupees 5 lakhs, that is 2.5 lakhs, but the escaped income is mentioned as rupees 5 lakhs, it shows non-application of mind by the officer as well as a mechanical approval by higher authorities, and therefore the notice under section 148 as well as order under 148 AD was quashed and set aside by the High Court. Siemens now already indirectly approved by Supreme Court in Rajeev Bansal. Next judgment of Bombay High Court, Chitra Supekar. In this case, there was some change of address of the assessee, which is already informed to the officer. Still, 148 AB notice was sent on the old address, which naturally assessee did not receive, and ex parte order was passed under 148 AD. Thereafter, on the registered mobile number, one SMS alert was received about the reopening. Assessee approached the assessing officer, who handed over the notice under section 148. However, the entire procedure under section 148A could not be completed. Court held that before issuing the notice under 148 AB, it was imperative for the AO to have checked if there was a change of address. Jurisdictional condition under section 148A is to serve a proper notice under section 148 AB. Since this has not been done, the notice is bad in law. I'll conclude my presentation with this one last judgment of Karnataka High Court, which is very interesting and important. And then we'll see if there are any questions. Sanat Kumar Murli versus Income Tax Officer. The time limit for reopening under the amended regime under section 149 is normally 3 years from the end of the assessment year. However, beyond a period of 3 years, assessment can be reopened if the escaped income is more than rupees 50 lakh. Now, the dispute here was on the interpretation of the word income chargeable to tax. The transaction was on capital gain. Full value of consideration was more than rupees 50 lakh. But after giving deduction for cost of acquisition under section 48, the resulting capital gain was less than 50 lakh. Reopening notice was issued beyond a period of 3 years from the end of the assessment year. And therefore, assessee challenged the notice on the ground that it is time barred because my income in this transaction is the ultimate capital gain, which is less than 50 lakh. Department's argument was that at the stage of 148 AD order, this computation need not be done because the consideration of the transaction was more than 50 lakh. The income escaping assessment was more than 50 lakh. Karnataka High Court did not accept this argument and said that the income chargeable to tax in the context of capital gain must be interpreted in accordance with section 48. It's not the full value of consideration, but only the taxable capital gain which should be considered. And therefore, if the computation of capital gain after section 48 is less than 50 lakh, notice issued beyond a period of 3 years is time barred. I think I'll stop my presentation here. If there are any questions, I'll take up those questions. I once again otherwise thanks BCS as well as my office people who helped me in making this presentation.
Yeah, Devendra, we have a few questions. Should I read out or?
I will read, sir. Where are the question and answer?
Yeah, 7 questions are there. Yeah, 7, 8 questions. Yes.
Ketan Vajani sir has asked the question, what if the assessee has not replied at all to 140 AB notice? I believe this question is in the context of calculation of surviving period under as coined out by Supreme Court in Rajeev Bansal.
That's right.
So post Ashish Agarwal, when the material or information was shared by the assessing officer, if assessee has not at all replied, still 2 weeks period which was granted to the assessee to reply, in my view, that will be considered as an exclusion under third proviso to section 149. And so once the material is shared by the officer, add 2 weeks to that, and thereafter you add the remaining period till 30th of June 21. According to me, that's the way it should be calculated. Next question is, what about cases where assessment order has been passed by March 2022? This was actually a very interesting proposition that even before Ashish Agarwal judgment, those people who have not challenged the reopening notice under section 148 by way of writ petition, in many cases the assessment order itself were passed before March 2022. My personal view with due respect is that once Supreme Court has reiterated that Ashish Agarwal judgment will apply to all the 90,000 notices issued between April 21 and June 21, therefore irrespective of the stage at which the case was, whether it was pending in the High Court, whether it was disposed by the High Court, whether assessment order itself is already passed and appeal is filed, not filed, all those notices will have to be tested in terms of Rajeev Bansal judgment, in terms of surviving period, or in terms of if assessment year 15-16, it's bad in law. If assessment is 16-17, 17-18, if it is a wrong sanction, these are bad in law, and assessee may take appropriate remedy to seek relief, even if the assessment order is already passed. Also, what will be the position where the assessee is replied within 7 days instead of 14 days here also, in my view, then if he has applied after 7 days, immediately after 7 days, the assessing officer was seized of the matter, and therefore the limitation would end within 7 days and not till 2 weeks period. Because 2 weeks was the maximum period to assessee to apply, reply to the officer. For assessment year 15-16, 148 AB issued, allowing time up to 18th of April 22, and 148 along with 148 AD order issued on 21st of April, whether valid. 15-16, if the first notice was issued in June 21, then department itself has now accepted that these notices are bad in law. Notice under section 143(2) mandatory in the scheme of assessment under section 153 or 153C. Though not on this particular topic, but personally I feel yes. Even in 153 or 153C, 143(2) is mandatory. This is second proviso to 143(3) where the EO makes a reference, and in the third proviso, the EO recommends what is so much difference between reference under second proviso and the recommended under third proviso. Again, I think this is not with reference to our topic.
Yes.
Try to skip this question because we'll have to refer to the relevant provision. For paucity of time, we cannot do this. Even the next question relates to second proviso to 143(3). Even third does not relate to this topic. Can we give the PPT? Yes, of course. I'll share it with the BCS. My client has received order under section 250 and the appellate authority has been quashed as the assessee did not reply to any of the notice to assessee by appellate authority. Can the assessee apply to reconsider the issue and get one more opportunity of being heard? Again, not on the topic, but of course, naturally you can do so. Even if you can go to the tribunal, it will be set aside. I request you to please share at least the decision you had covered. You say, I'll share the presentation. Revenue considered for AY 15-16, does it apply to income above 50 lakhs also? Yes, irrespective of the income. 15-16, everything goes. Whether we should ask reason for reopening of assessment now 148A or 148 proceeding as we are requesting earlier after issued the notice 148 of the Act. See, now under the new regime of assessment, if a direct notice is issued under section 148, for example, if it's a search case, where 148A is not mandatory, then directly a 148 notice is issued. In my view, then the ratio of Supreme Court in JK and dry shaft will still apply. If a direct 148 notice is issued, then assessee can ask for the reason and assessing officer would be bound to give. What if the sanction of PCID is not provided on portal? Only mentioned as taken in the notice. If it is not provided on portal, of course you can challenge it. If it is actually taken with the proper signature and document identification number, then it will be a valid approval. Otherwise, you can always challenge it. Next question, what is the position? The assessee already replied to 148AB within stipulated date, but the EO Suomoto issues one more notice under section 148AB effect on surviving period theory. This is also very interesting. In fact, in one of the cases, real life cases which I have handled, I have objected to the assessing officer that I will calculate surviving period from the first 148AB notice because you had sent me this notice. I have already replied to this. The second notice under 148AB was a frivolous notice just to buy time. I have objected on that basis. More than 1 month has occurred. He has not responded. Let's see what course of action he takes. Whether the AO sending notice under 148AB by email in the ITBA portal is sufficient enough, even though the email in the latest ITR is different. What is the email is supposed to use? Is notice under 148AB mandatory to be sent by speed post? If you refer to section 282, read with the rules, there are various modes of service. And I believe merely posting on the ITBA portal is not sufficient. At least an email is required. Last question, where 148 notice issued for AY 15-16 on March 21, but notice comes to know about notice in October 21. Will Ashish Agarwal apply? Notice issued on March 31, 21. What will have to be seen is what is the date of service of notice. If it is served prior to 31st March 2021, then it will be considered as if it is under the old regime. Whether if notice is found bad in law at the initial stage of issue, can it be closed by the ITO? Of course, yes. It can be, but he will do it or not is a different issue. Whether the new regime applies for assessment year 15-16 to issue notice under 148AB within March 22, is it valid? Yes. If it is not post Ashish Agarwal directly issued in March 22, that 15-16 notices are not affected by this whole controversy. What if the notices are not signed and token not affixed, but only the designation and name are printed? I think Allahabad High Court in Vikas Gupta has already decided in favor of the assessee that just mentioning the designation and name is not sufficient. It will have to be either manually or digitally signed. Many such petitions are already pending before the High Court. Our High Court, Bombay High Court, has not taken any position on this as of now. I hope I have answered all the questions appearing on the screen.
Yes.
Over to you, Deepak bhai.
Yeah.
Deepak,
Yeah.
you
Sorry.
want to take it or?
Yeah, you can take it, please.
Okay. Yes, Devendra. Only one small thing. Blue Moon was 153A, 153C, na?
Yes. It was 158 BD, but
Acha, 158 BD. Okay.
Yes.
Okay. So 143 wala might get covered there.
yes.
Anyway, so we have had an excellent session from Devendra, explaining to us the niceties of the 2 or 3 judgments, particularly of the Supreme Court. He took us through some other judgments also in regard to reassessment. In fact, reassessments has now become a virtual, topic of discussion in every office of any professional. Earlier in the good old days, when a 148 came, the simplest thing was only to ask for reasons. We used to look at period very cursorily, because at that point of time the notices were manual. So you simply looked at the general time frame, and if it was within the time frame, at best look at cutoff periods, etc. But now with all these complexities, I think every time a notice comes, you have to prepare a tabulation as to right from when 148A was issued, 148 was issued, where is the sanction, and so on and so forth. Devendra has excellently analyzed a very complex ruling of the Supreme Court. Complex because it covers, as he rightly pointed out, 3 different categories of cases, and in all the 3 cases, except for 1516, which is relatively simple, the ratio or the logic is distinct and different, and therefore excellent, Devendra, for your presentation, and we hope that we will have you back again, and maybe not on such a complex subject if litigation as is vowed by the Honorable Prime Minister reduces, though in the near future, I don't see much chances of that happening. So thank you, Devendra, very much. Despite the initial glitches, you did an excellent job. Thank you once again. Right.
Thank you very much. It was my pleasure.
Thank you.
And my apologies for some technical.
No issue. Deepak, we'll take a break or we'll start off. Deepak?
1 second. Yeah, Anil bhai. Yeah, we'll take a break of 5 minutes.
5
and,
minutes.
Yeah. And
Yeah.
we'll start.
Ajay is
Ajay
there?
Singh is joining us in 5 minutes, so
Okay,
we'll just
fine,
take a
fine.
break in
Then
5
we'll take
minutes.
a break. Okay.
Yeah. Okay. Yeah, hi Ajay.
Yeah, hi. Hi,
Yeah.
Deepak.
You would like to try your screen sharing?
Yes, 1 second. I will just try one.
Yes, yes.
Is it visible?
Yes, yes. Yeah,
Is it visible now?
yeah. Yes, Ajay, it's visible.
Okay, okay.
Yeah.
1 second.
And you want to test your video also?
Yeah, 1 second. I'm just adjusting the screen once.
Yeah.
Deepak, I can log in from one more laptop now on this same.
Yeah, you can log in, but I don't know, then there would be
Yeah,
humming sound.
sometimes it's
Humming sound will be there, humming or
No, I will put that switch means the audio off in that.
okay,
Okay,
let's
fine.
try. Let's try.
Yeah.
Let's try it. Yeah.
I'm
If
just
there's
keeping
no
it
humming
as
sound,
a
then it's fine.
yeah. So I'm just keeping the second laptop in case of a
Sure.
sure, because in this suddenly I don't know why it got switched off. Right
Yeah.
now it's perfect.
Yes. Okay, no issues.
So I'm just putting the second. I will also log in, but I will keep everything off in that.
No problem.
That humming,
Yeah.
humming sound, etc. is not.
Yeah. Yes.
Otherwise, yeah, everything is fine. I am ready.
Okay. Just now you can close this screen sharing off. Once we,
Yes.
I think Anil bhai will start kick
Yeah,
off and then
I'll-
you can, yeah. Just wait for 2 minutes. We are told
Sure.
5 minutes. That's why.
Yeah. And meanwhile, I will just log in from the second
Sure.
laptop.
Yeah. It started 5:40, so 2 minutes are there. Yeah.
Yes. Okay.
Want to start, Deepak?
Yes, Anil, we can start.
Yeah.
Okay. Yeah, we can start recording. Good evening, participants. We are back with the second session. In the first session, we have had a treatise on reassessments, the law as leading from Ashish Agarwal up to Rajeev Bansal. But while reassessment is certainly the flavor of the season, as professionals, we have to deal with many others. And the law keeps on marching. We have various other aspects, various other subjects where also the law has significantly developed. In fact, at one point of time in my practice a few years ago, one felt that litigation would gradually peter off. But fortunately or unfortunately, quite to the contrary, we have seen the litigation increase in the recent years. And there are, numerous decisions now of the high courts, of the tribunals dealing with various facets. In this second session, we will be having uh, Advocate Ajay Singh dealing with the various recent rulings apart from reassessments, which Devendra dealt with. I have known Ajay for some time. He is a brilliant advocate, brilliant young advocate, I must say, because my graying years give me that benefit of age. He is my colleague on the ITAT Bar Association Managing Committee. He is currently the Vice President of the ITAT Bar Association. He has been a avid writer, speaker. He has written books on some on prosecution, on appellate proceedings, and also reassessments. He has spoken across the country, and now because of the virtual mode, his reach is far and wide. I'm sure all of us will enjoy a session with him. He'll take us through the various nuances of the law as are developing in various categories. So therefore, without wasting time, over to you, Ajay, for your presentation. Thank you.
Thank you, Anil. And thank you, Deepak, BCA, for giving this opportunity for me to speak. I will share the screen. Yeah, the screen is visible, Deepak?
Yes.
And my voice is audible?
Yes.
Can you be a little louder?
Yes.
Yeah.
Perfect.
Fine.
Okay, great. So what I have done, I have selected few decisions which are of day-to-day use, also some landmark decisions, and I have a mixture of tribunal, high court, as well as of Supreme Court decisions. So before we start, let me tell you that let's not take this decision as a final verdict or treat these decisions as a theorem or a formula. When you apply these decisions to facts of your case, always read a decision in the context of the question, the facts, what was there before the court or the tribunal, and in that context, what the court has looked into and decided the matter. Keeping this in mind, let us start. If you will see the screen, I have shared the name of the case name, the issue, and what is held. The last column is references, which I have just kept it that you can refer at a later point of time. These might be some other decisions on the same issue, decisions which have been referred in the matter. I have thought to list them out so that it can be useful to the participants while looking into the particular issue. So let's start with the first decision which I have selected is in regards to exemption claim under section 54F and capital gain. So here is a case where the SSE was a owner of a residential house along with his wife. They sold this property, and considering their family size, which has increased, they bought 3 residential houses which were adjacent to each other. While buying the new house, residential house, they had purchased, the SSE had purchased in his name and in the name of the son. They had 3 sons. The second house was purchased by the wife and in the name of second. The third house was purchased by the wife and the name of the third son. So like that, they tried to, considering the age factor, they tried that the new house, let the joint owner be the children, and therefore they purchase in this particular manner. Whatever was advised by to the SSE, he simply worked out the capital gain in his hand, and he offered that to tax claiming exemption in respect to the investment made in the 3 house. The assessing officer looked into it and he disallowed the claim, saying that the other 2 houses are not in your name and therefore you will not be entitled to exemption under 54. He gave the benefit as far as 1 house is concerned, which was standing in his name. When the matter came up before the tribunal, we found this particular issue and we found how to come out of this issue. Considering a decision of Prakash versus ITO, 312 ITR, page 40, Bombay, which is of Bombay High Court at Nagpur bench, which denied the benefit in case of a joint ownership. The house is, the investment is made in the name of a third person, a third family member. The exemptions were denied. So it was difficult to claim as far as the exemption in respect of the other 2 house. But we looked into the fact that the original house was in the name of husband and wife. The investment subsequently has been made by both if we consider the other 2 houses also. Considering all this, we made an application before the court, and we first of the argument was that the capital gain need to be split and it should not be taxed in the hands of the SSE. The capital gain has to be split in the name of the SSE as well as in the name of the wife. And accordingly, the exemption should be allowed. Merely because there is a joint name of the sons, the exemption, SSE should be entitled to this exemption. The first objection which came is that this is a new claim. You have not made, you yourself had offered this particular amount, capital gains in your hand, and now you want to split. We raised this plea that yes, this claim is there, but assessing officer is also bound to work out the correct capital gain in the hands of the SSE as well as his wife. We cited the decision of Bombay High Court in the case of Nirmala L. Mehta, 269 ITR 1, that the claim can be raised even before the appellate stage and the right amount should be taxed in the hands of the right SSE. We also cited the decision of the Supreme Court, which is mentioned in my reference column, and said that only the right person should be taxed. Putting this plea, the tribunal accepted our first plea that yes, the capital gain in the hands of the SSE should be taxed to the extent what has arisen in his hand in regards to the property, 50% of the share which he had in the property which was sold. The second plea which we made before the court is regarding the exemption. Once the capital gain is computed 50%, we made the claim of exemption in the hands of the SSE as far as the one of the flat is concerned, which the assessing officer also had agreed. Considering that the capital gain in the hands of SSE was almost coming to negligible amount or almost nil, and the tribunal accepted that the balance capital gain, even if it is taxed in the hands of the wife, the working if which was produced before the tribunal, they were satisfied that there would not be any taxation in the hands of the wife also. It was merely the working initially what the SSE had done, because he had not split the capital gain. This exemption was denied to the SSE. Overall, the capital gain was exemption was denied. Considering this, the tribunal referred to these decisions, and they said yes, the SSE and his wife both were beneficial owner of the property, and by selling the original asset, both the SSE and his wife gained the capital gain, and the income will be distributed in both the hands, but not the SSE alone. So this is one of the case which I found that nowadays, considering the properties which are bought are purchased in joint names, and whenever the sale takes place, one needs to keep this factor in mind, how to offer the capital gain and claim the exemption. And this, if we do it with proper understanding, unwanted litigation can be avoided. Considering that exemption, also claiming of exemption is also one of the way how we will move forward when a capital gain arises. This proper planning in case of a capital gain is required, or unnecessary, the SE is saddled with tax liability. Moving to the second decision, which is in the case of Naren Kumar Jain. This is also a issue in regards to immovable property, where the SSC 56 Roman 10 2 subsection 2 Roman 10 had been invoked by the assessing officer, because he found that the difference between the sale consideration and the stamp valuation were different, and therefore he wanted to tax this differential amount under section 56 Roman 10 under the head income from other sources. The SSC had taken the plea that, look, this flat the SSC had agreed to purchase in the year 2012. And in terms of that understanding, there was a letter of allotment, and also there was some payment which was made through a banking channel, which was accepted by the builder. We also showed that there were receipts to that to support the payments which were there, and subsequently also at a regular interval the payments were made as per the schedule provided by the builder. The assessing officer rejected this plea, saying that this allotment letter cannot be given any due evidentiary value, considering that this allotment letter is not part of the registered agreement. There is no reference of this allotment letter in the registered agreement. And once this allotment letter is not registered of being part of the registered agreement, it cannot be given any due credentials. When the matter came up before the tribunal, we, through the receipt of which is part of the registered agreement, we were able to show the payment schedule which was there, and that as per the proviso of section 56(2), one of the condition is that there has to be an agreement and there has to be a payment of the mode specified, which is through a banking channel. Through the receipt, which was a part of the registered document, we showed that, look, these are the receipt which very clearly shows, which is supported by the bank statement, which very clearly showed that the payment from 2012 till the date of registration in financial year 1920, on various occasions, the payments has been made by check. The second aspect, allotment letter. The tribunal looked into the allotment letter and say, yes, this allotment letter, which is though not registered, but the parties have acted on the basis of this allotment letter. They have come to a certain terms and conditions about purchase of the property, and there is no requirement that this allotment letter is required to be registered. The reason being, the proviso asks that there has to be an agreement what should be the form of agreement has no. An agreement can also be in a form of a letter, understanding between two parties. The only requirement is that we have to show that yes, the parties have acted on the basis of that agreement. The tribunal looked into all these aspects and they came to this conclusion, yes, the parties have acted on the allotment letter. The payment schedule shows that yes, they have acted on the basis of whatever is the schedule mentioned in the allotment letter. And ultimately, the transaction has been entered by way of a registered documents, and both the parties have agreed to this terms of allotment letter. Considering this, the tribunal came to the conclusion that there cannot be uh, an addition under section 56 to Roman 10. The court also looked into fact, which was also argued by the SSC, that as on 2012, the rate and the price which was fixed by the parties, this was in accordance with the stamp duty valuation. It was matching with the price of stamp duty, and therefore there could not have been any addition as far as the present transaction is concerned under section 56 to Roman 7. This is also an issue which we are facing constantly. These types of issues are coming up before the lower authorities. Reopening are being done on this issue, especially we see in the case of an NRI. So I have also listed some other decisions also on this issue. One can take benefit of this if we file a proper reply before the lower authorities itself, giving these explanations with proper documentary evidence in support of their claim. Uh, According to me, the authorities will accept this particular position that there cannot be any addition under 56 to 10. The only requirement is that you have to very clearly demonstrate before the authorities that the payments have been made by the mode specified, that is through banking channel, and there has been some agreement between the parties which they have ultimately acted upon. Making general or oral statement will not work. Whenever you show the payments has to also be supported through bank statements or the receipts from the builder. Moving further to the third decision, a very interesting decision of Supreme Court in the case of Jupiter Capital. This is a decision. Just one second. I am just opening the decision. Yes. So this is a decision of Supreme Court where the issue was regarding reduction of share capital, whether there is a transfer and whether there is a question of any capital gain or loss which can arise in this matter. This was an appeal filed by the department before the Supreme Court against the order of Karnataka High Court. The issue before the court was, I will just explain the facts in brief. The SSC had made an investment in a Asia Net News Network Private Limited, an Indian company, engaged in the business of telecasting news. He had almost 99% number of shares, which was ranging somewhere around 15 crores, 35 lakhs. The company subsequently had resulted in loss, and therefore the company, the investment where the investment was made, that company decided that to reduce its share capital, to set off its losses, a petition was filed before the High Court, and pursuant thereto, there was reduction in number of shares. However, the face value of shares remained the same, that is at rupees 10. even after reduction in the share capital. There was certain payments also, which was pursuant to the High Court order. There was some in the scheme of reduction of capital. There was also a certain amount which was paid to the SSE as a consideration. The SSE computed its capital gain and arrived at a long-term capital loss in view of reduction in the share capital from the sale of shares of the company. However, the assessing officer disagreed with this SSE's claim and held that the reduction in share of subsidiary company did not result in transfer of capital asset under Section 2, subsection 47 of the Act. The assessing officer took this view primarily for the reason that although the number of shares has reduced by way of reduction in the share capital, yet the face value of each share as well as the shareholding pattern has remained the same. For doing so, the assessing officer relied on the decision of Karthikeya Sarabhai, CIT versus CIT, reported in 7 SCC 524. And he said that any extinguishment of rights would involve parting of sale of some percentage of share to another party, which according to him was absent in this case. The CIT appeal also upheld the view of the AO. When the matter reached before the tribunal reversed the decision of CIT appeals and allowed the appeal of the SSC by observing that the decision of Karthikeya Sarabhai is squarely applicable to the facts, and the assessing officer as well as the appellate CIT appeal has failed to look into the facts of that case in a proper manner. The ITAT observed that in the case of Sarabhai, there was no reference to the percentage of shareholding prior to reduction of shares capital and after reduction of share capital. Hence, the CIT appeal wrongly held that the facts of that case was squarely applicable to the decision of the facts of the present case. They also the tribunal case, they have misinterpreted the decision, because in fact the decision upholds the view of the SSC about the claim of capital loss on account of reduction in the share capital. The department, not being satisfied with the order of the ITAT, preferred an appeal before the Honorable High Court. Before the Honorable High Court, the primary issue which was raised was whether the reduction in share capital of subsidiary company and subsequent proportionate reduction in the shareholding of the SSE would be squarely covered within the ambit of expression sale, exchange, relinquishment of the asset used in Section 2, subsection 47. The court affirmed the decision of the ITAT, and they held that the assessing officer view that the voting power has not changed and has remained unchanged, and therefore there is no transfer, cannot be accepted. Because if the shares are transferred at the face value, the redeemable value would be, they have made the calculation of number of shares and the value, and they said that the ITAT rightly applied the law and correctly held that there is a transfer, and therefore there was this long-term capital loss which has arisen should be allowed. The department preferred further appeal before the Honorable Supreme Court, and they challenged the findings stating that the High Court as well as the ITAT wrongly applied the law. And this is a case where Kartikeya Sarabhai has been not correctly interpreted by both the lower authorities. The Supreme Court extensively dealt with this issue, dealing with the decision of Kartikeya Sarabhai, and they elaborately extracted the observations of that decision in the order. And they finally came to this, that section 2 subsection 47, which is an inclusive definition, provides that relinquishment of an asset or extinguishment of any right therein amounts to transfer. The court also observed that a company has a right to reduce the share capital, and one of the modes which could be adopted is to reduce the face value of the preference shares. While the taxpayer continues to remain a shareholder of the company even after the reduction of share capital, it could not be accepted that there was no extinguishment of any part of his right or shareholder qua the company. So the court basically interpreted the definition of term transfer under the Income Tax Act, section 2, subsection 47, and gave that it is an inclusive definition. One cannot have a very narrow view, especially in the facts of this case, where there was reduction in the share capital of the company. The court also observed that when, as a result of reducing the face value of shares, the share capital is reduced, the right of the shareholder to the dividend, share capital, etc., is extinguished proportionately to the extent of reduction in the capital. Such reduction in the rights of the capital assets clearly amounts to transfer within the meaning of 2 subsection 47. While interpreting the term extinguishment and relinquishment, the court also referred to various other decisions like the CIT versus Vanya Silk Mills, Commissioner versus Jay Krishna 231 ITR 108. So the court, after extensively reading and going through these decisions, came to the conclusion that the reduction in the share capital of the subsidiary and subsequent proportionate reduction in the shareholding of the SSE would squarely be covered within the ambit of expression sale, exchange, or relinquishment of asset, as these terms used in section 2 subsection 47. And in result, the appeal of the department was dismissed. A very good decision. Lot of issues and clarity as far as the earlier decisions are there, referring to them has been made in this decision. I will also request that one can also go to the decision of Tata and Sons of Mumbai Tribunal, wherein on a similar situation, which was dealing with amalgamation, which led to reduction in shares, the court have held that yes, there is a capital loss arising to the SSE on account of reduction of capital, and a set-off can be allowed under any other head of capital gain. So one can also refer to the decision of Tata Sons, which was prior to this decision. We will move to the next decision, which is in the case of Nav Chetna Charitable Trust. It is in context to condonation of delay in filing Form 9A. So we see very often, very commonly, this is a mistake. There is some mistake in filing Form 10B, 9A, similar forms by the charitable trust. There are also delay in filing their return. CBDT has time and again issued circular giving powers to the various authorities, commissioner exemptions, CBDT, to condone the delay in filing the return as well as filing the form. However, if you read the relevant paragraph, it very clearly says in the circular, it very clearly says that the delay would be condoned subject to the SSC furnishing a proper and sufficient cause for the delay. Unfortunately, what I have seen, many times these circular are cited as if claiming a right that yes, there is a delay, and now this circular permits the officer or the authority to condone the delay. But it misses to see or read the circular in the correct context, that it also says that the reason for condonation of delay in filing the necessary form, return, etc. should also be satisfied. And many times I have seen, whenever we give this explanation, which these are very general in nature, not supported by any document or with proper explanation. This is in this facts of this case. Also, there was a delay in filing Form 9A. The Form 9A from 16 year 16, financial year 16-17, there was change in the procedure whereby this form was required to be filed electronically while filing the return of income. As I said, the SSC missed to file this his return in time. In view thereof, the claim of the SSC in regards to certain deductions, that is of certain interest income, was denied to the SSC in the course of the assessment. During the course of the assessment, also, the SSC realized that this form he has not filed. And therefore, in the course of the assessment, though he had made a revised claim before the assessing officer about the interest income which is accrued but not received, or which he was required to submit this Form 9A, but there was no such form filed. The assessing officer, as I said, didn't allow this claim of deduction. During the course of the assessment, the assessing officer had noticed certain mistake in the return in regards to a depreciation claim and also of a expenditure which our SSC had claimed. In that context, the SSC had filed the revised return also, a revised claim before the during the course of the assessment proceeding, rectifying its claim or return before the SSC and taking back its claim, admitting yes, the claim of depreciation was wrongly calculated, as well as an expenses towards a capital expenditure was also corrected, which led to a income in the hands of the trust. This income could have been set off if this Form 9A and the claim in that regard would have been placed before the officer. Though the claim was there, but as this form was not there, the assessing officer refused to look into this. As the assessing officer completed the assessment, immediately 3 to 4 days after, the CBDT came out with a circular permitting the SSC to file this Form 9A with an application for condonation of delay. The SSC immediately filed this Form 9A with an application for condonation of delay, giving its explanation that why he could not file earlier. Though it was not very well supported with good reasons, but he explained and furnished whatever was available with him. and said that this fact was informed to the assessing officer. However, I could not have filed this because there was no CBDT circular permitting me to file this form. Though for earlier assessment year, there was a circular, but for the relevant assessment year, the circular had not come prior to passing of the order. The commissioner, where the application was filed, rejected the explanation of the SSC and dismissed its application for condonation of delay, citing various reasons. One of the reasons cited by the principal commissioner was that, look, in your return, you had made a wrong claim in regards to depreciation as well as some capital expenditure. In the course of the assessment, you found this and you tried to overcome that. In lieu of that, there was a taxable income. And now you have realized about this Form 9A to make this claim, and all this is an afterthought. The assessing officer, the commissioner also referred that you have not given proper explanation. You have not given the reason who was responsible person because of which the delay has happened. The commissioner also made certain comments that the SSC had all his professional advice and therefore he should have complied with the requirement. And this excuse is very general and lame, and therefore this delay cannot be condoned. The SSC came up before the Honorable High Court by a writ petition, wherein the SSC explained the whole issue and explained that how the hardship will be caused to the SSC if this claim would not be allowed. The SSC also explained that the CBDT continuously right from 16, 17, 17, 18, 18, 19 and subsequent years, time and again has issued circulars granting the powers to the authorities to condone the delay. The SSC, being a trust running schools and colleges, explained whatever the facts was there. And he also explained that in the course of the assessment, the SSC had raised the claim, but the claim could not be allowed in view of Form 9A was not filed. The court looked to all the facts and said that the purpose of 119(2)(b, read with these circulars which are there, is basically to grant relief to the SSC wherever they are entitled to. For condonation purpose, one has not to be very technical and rigid, more so when the SSC are entitled to a relief, and therefore the delay ought to be condoned. The court, after looking into it, the court also went into the claim of the SSC, and in the order they have extracted the computation how the SSC would be prejudiced if this claim would not be allowed. After referring to all this thing, the court came to the conclusion that this is a fit case where the delay should be condoned, and the argument of the departments being too technical in nature cannot be allowed. The court also went into the issue that the commissioner, while considering the condonation application, erred in mixing the issue of assessment with this application. The issue of assessment, whatever mistake had happened and whatever ultimately the computation was done, was an independent issue. While considering the application for condonation, he should not have mixed up this particular issue. In keeping in this, the court extensively dealt with this subject matter, and they came to the conclusion that the delay should be condoned. This is a good decision, a detailed decision, where one can consider whenever there is a delay in filing these application under one, and you are filing an application under 119 before the CBDT or the authorities where the powers have been delegated, you should give the proper reason along with the supporting documents where they can consider all these things, and you can cite these decisions to get the application through before these authorities. On a similar line, there is a second decision also of Smita Dilip Ghule. Here, the facts were in context to return filing, there was a delay during the COVID period, the first wave of the COVID period. And the SSC, being a doctor, she was posted on certain COVID duty. There was a long-term capital, there was a capital gain arose in her hand, there was a sale of property. And while filing the return, there was an issue in regards to valuation. And this valuation required a valuer to come to the place, look into the various documents, the deeds, the earlier agreements, and which took certain time. The valuation was delayed because of COVID wave. She herself being a doctor, there was a death in the family. The valuer himself was of a senior citizen, and therefore he could not have come out or traveled for this purpose. Considering all this factor, the court said that again, genuine human problems and fact coupled about the COVID situation, this was a fit case where the delay ought to have been condoned. However, again, here the authorities had taken a hyper technical view in rejecting the application. The department had taken various plea that you could have done the valuation at the time of sale, which was prior to the COVID. You could have done, and various arguments has come from the department. But all the arguments were rejected by the court, and the court again came to the conclusion that in this situation, the delay should be condoned. Whatever the matter is there on the merits can always be looked into later on while considering the return or the claim. But as far as the applications are concerned, that has to not to be hyper technical view should not be adopted. The third decision in the same category is also on the same lines where there was delay in filing 2 days. This decision also throws a light that how the department is dealing on such issue and taking such a hyper technical view. And therefore, friends, whenever this type of situation arises, the first thing is what as a professional we should advise the SSE to bring and keep the necessary records and evidence correspondence on record to satisfy the authorities in this regard. Now, here also it was a case where there was a 2 days delay in filing the return and the Form 10 IC. And the technical difficulty what the SSC had faced is the glitches in the computer and the income tax portal due to some incident of fire which had taken place in his building. And all this evidence supporting the fire incident, etc., was given to the authorities. Still, the 2 days delay was there, which was not looked into by the authorities, and this SSC had to come before the Honorable Court. The court was good enough to condone the delay and allow the claim of the SSC. The point what I want to drive from these decisions is that these are the situations where the CBDT has given and delegated the powers to these authorities to exercise. But one of the conditions which is there that there has to be a sufficient reason for condonation of delay. So whenever you are filing these applications, you should see and weigh that yes, your applications are supported with proper reasons before these authorities. Along with then after you can take support of these decisions to buttress your argument for condonation of delay in filing this application. Going further, the fifth decision is in the case of Bloomberg. Now, this was a very interesting decision in regards to refunds. And many times you will find that your SSC are entitled to refund, but the department are just asking you to go move here and there, and some reason or the other, the refunds are not issued. Many times they give a reason of CPC, then they give reasons, some weird reasons. What, as per our experience, we have seen, the moment you go to the court, challenge the refunds is not been issued, the courts immediately grants you the department immediately grants you the refund. That was the same situation in this case. When the matter came up before the court, the department admitted and accepted, yes, there is a refund which was due, and this refund was to be paid to the SSC. The department also, within the first, second year gap of hearing, paid the amounts. However, the department failed to pay the interest on the delayed payment of refunds. The SSC took this matter and said that once this amount was crystallized, there was a delay on the part of the department to pay this refund, and therefore interest was payable. When the question was put up, necessary affidavit was filed by the officer, wherein he admitted, yes, there is a delay and there is certain amount of interest which would be payable. The interest was again running in crores of rupees because the refund was also in crores and the interest part also ran in same amount. The court, upon seeing the affidavit, came to the conclusion that regularly these types of cases are coming before the court, that the moment this matter comes in and the SSC challenge and brings the matter before the court, the department immediately agrees to grant the necessary refund. But at the same time, interest are also payable. And this is because of the default on the part of a particular officer or the commissioner, whoever is there. And this leads to a situation that such a high rate of the amount of interest is payable to the SSC. This is a loss on part of government due to the laxity of the officer concerned. The court questioned who are the responsible person and whether there are any rules framed in regards to fixing the accountability in such type of cases. The court posted the matter and they found the reply, whatever was received by the department, the court was not satisfied. The court directed that this matter should be taken up at the higher level, where the CBDT should inform whether there is any accountability, and if there is no such guidelines, rules, then such an accountability should be fixed on the concerned officer who will be responsible for payment, for delay in payment of such interest. The court said, also observed that such amounts are being paid merely because the officer concerned are not taking these matters seriously, because they are not liable, but the government is liable. Once the government is liable, again, it is going from the pocket of the citizens. This amount could have been used for many other better work, but merely because of delay on the part of the officer, the public exchequer has to bear this burden. And this should have been some accountability fix on the officer. Considering, the court issued necessary direction and asked the department to frame or necessary guidelines in this regard. A decision wherever the SSC refunds are stuck and the officers are not looking into it, a good decision where you can bring to the notice of the officer that yes, once the refunds are due, admitted, then this refund should be granted along with interest. And if there is delay for no reason by the department to issue such refund along with interest, the court may fix up the responsibility and accountability on the particular officer for such delayed payment. The next decision is of Rahul Dinesh Bajpai, which is in context to TDS. One second, I will just open the decision in my. Yes. So this was deduction of tax, sale of property jointly owned by SSC. So I had taken the first decision also in a case of a joint holding property. This is a issue which is time and again which is coming. Many times SSE innocently, when they enter such transaction, they may not take the proper advice of their professional chartered accountant. And later on also, while putting up all the facts before their professional representative, they try to say, yes, there is a sale which has happened and this is the amount which has been received. This is a classic case also where the SSE, though holding a joint property, sold jointly, total consideration received. The capital gain which arose was offered in equal proportion in the hands of the SSE and his wife. However, the TDS on the sale consideration was deposited in the name of SSE alone. While processing the return of income filed by the SSE, CPC granted credit for TDS in proportion to the capital gain declared by the SSE and disallowed the claim of the balance TDS. From the facts of this case, it is very clear that the wife has not claimed the credit for TDS. It was only the husband who had claimed. When the matter was before the tribunal looked into this matter and the tribunal came to the conclusion that it is a very clear, simple case where department is not disputing that there is some benefit or some planning or something else is there in this matter. It is a very simple case where the SSE and his wife being joint owner, while the tax deducted was deducted in the name of the husband and therefore the full credit was claimed by him. The tribunal accepted the plea of the SSE and directed the assessing officer to allow this credit subject to verification that the wife, the same TDS credit has not been claimed in the hands of the wife. So, considering this, the court has taken a very wide and justice-oriented approach, allowing the credit in the hands of the husband. So this is a good decision where similar type of situation arises. Most of the time, the transactions are entered by the parties, and thereafter this situation arises. And yes, to some extent, CPC, who is processing the return, they don't have the benefit of other issues. But yes, when the matter for rectification or the matter is before the assessing officer, you can always show both the returns and say that it is merely a matter of tax credit claiming in one hand because of the particular TDS certificate being issued in the name of one of the joint holders. Yeah, court has taken this view and allowed the benefit. So a very practical approach of adopted by the tribunal to give the relief to the SSE concern. The next decision is again of a Mumbai tribunal in regards to remittance of fund. Very simple and straightforward facts here that the SSE company, a tax resident of UK, registered with SEBI in India, a foreign institutional investor sold certain equity shares held in the Indian company. There was certain long-term capital gain which was earned, which was claimed as exempt by the SSE. The SSA did not remit this amount directly to any other person or some third party, but it transferred it to its bank account maintained in India, to its own from its bank account maintained in India to its own account, which was located in UK. The question arose whether Section 195 would be applicable in this facts of the case. The tribunal looked into this case and said that the provision of Section 195 would come into operation only if a person is making a payment to any other person of any sum chargeable under the provision of the Act. It was not the case of the AO that the remittance was made by the SSE from its Indian bank account to its foreign bank account, which was chargeable to tax under the provision of the Act. Hence, the provision of Section 195 would not be applicable, and the SSE could not be treated as an SSE in default for not deducting TDS at source under Section 195 in relation to the remittance made by the SSE to its own foreign bank account. And therefore, the appeal of the SSE in that context was allowed. Coming to the 8th decision, Deepak Bihar Suryavanshi versus ITO. It is a Pune tribunal decision. Yes, it is a Pune tribunal decision wherein there was an issue of penalty under section 270 capital A. Before dealing with this, let me give you some background of this issue itself. There was a full bench decision of Bombay High Court, which I have referred on the right-hand side column of Bombay High Court, wherein the Bombay High Court, referring to many other decisions, said that once the notice which has been issued, the penalty notice which has been issued, and the two limbs which are there in context to 271(1)(c), concealment or furnishing of inaccurate particulars, if the officer has not marked or might specified that under which limb the notice is issued, the notice itself is defective. And once the notice is defective, the whole penalty proceeding is bad in law. This decision has been followed by a number of tribunals and high courts. However, in one of the case of Veena Estate, which I have referred in my note, Veena Estate Private Limited, reported in 461 ITR 483, wherein the SSE also raised this plea first time before the court. The Bombay High Court distinguished this decision of the Mohammed Farhan and said that the facts of that case were different, where the SSE had raised this plea at a lower level authorities, and therefore there was some prejudice caused to the SSE. But in facts of this case, that is the case of Veena Estate, the plea was taken first time before the court, and therefore there was no prejudice caused to the SSE. The SSE was well aware about the proceeding and the charge, and therefore such plea cannot be entertained. So by distinguish the decision of Mohammed Farhan, the court decided this particular issue against the SSE. Considering this situation, there was an anomaly of precedent which was there for some time. However, the Mumbai tribunal in few other decisions, which again I have listed out in the right-hand column, has been following the decision of Bombay High Court of full bench. The decision in hand which we are here supposed to discuss, which is a case of Deepak Bhika, which is in context to 270 capital A. The same principle that whether while issuing the notice under section 270 capital A, whether the assessing officer has provided which limb of section 270A is being invoked from clause A to F of section 270A(9) read with section 270A subsection 8. In case he has failed to do so, then on the same principle, why not the notice should be bad in law? The court referred to the decision of Mohammed Farhan, Bombay High Court 434 ITR, and they came to the conclusion, yes, the decision will be applicable to this particular situation also, and the notice under 270 capital A is bad in law. Here, while making this argument, the court entertained this pure question of law as an additional question of before the tribunal. The court also referred to the decision of Veena Estate, which was cited by the revenue, and they pointed out that in view of the decision of Veena Estate, which is a subsequent decision referring to the decision of Mohammed Farhan, this plea of the SSE should not be entertained. The tribunal, after referring to decision of Mohammad Farhan as well as Veena Estate, came to the conclusion that the decision of Veena Estate is distinguishable on facts because that was the first time this question was raised before the Honorable Court. And in that context, the court had decided that issue. Whereas in facts of this case, the issue is totally different. And this plea was already there before the lower authorities, and therefore the decision of Muhammad Farhan should be followed. So this is a very good decision. Whenever you are dealing with a penalty proceeding, these minor aspects should be looked into it. I have seen while replying to the penalty notice, a very casual approach has been taken by just referring that either we are in appeal, the matter is pending before CIT appeal, etc. is mentioned. This is a eye opener. These decision, if you see, it is very important that when a show cause notice or this notice of penalty is issued, you have to take a proper defense at the initial stage at the first level authority. If you miss to take this decision, rightly or wrongly, whatever will be the ultimate fate of Veena Estate is a different matter. But just to avoid a situation what has arisen in Veena Estate, it is very important that you make your reply to penalty notice very carefully by setting forth your facts as well as your legal arguments. Limitation issue, jurisdictional issue should be clearly raised before the lower authorities, as well as the facts has to be pointed out. One should know that the penalty as well as the quantum proceedings both are independent. Many times we have missed certain things or in the quantum proceeding, or maybe at a later stage we have become much wiser and we find certain more explanation, details, documents. It is very important that in the penalty proceeding, you submit those things and make a proper plea claim before the authorities, which will help you at a later stage or at the appellate stage in such proceedings. The next decision is in the case of Raju Ram Purohit, which is in context to section 68. Here, the case was basically of taking an unsecured loan from a company from the parties where the assessing officer found that those parties have been investigated by the department and those parties have been proved to be accommodation entry provider. And therefore, these loans are not genuine and this loans should be added to the hands of the SSC. The SSC had submitted all the evidence in regards to genuineness of the loan. The SSC also proved that, look, these parties have also replied whenever the notice under 133(6) was issued. The SSC also showed that the reference made by the certain statements, cross-examination, etc. has never been given, though SSC has demanded. SSC as a evidence has filed copy of PAN, ITR, confirmation, bank statement, and therefore all the necessary primary document from the point of view of the SSC in regards to proving the genuineness of the loan has been submitted by the SSC. The SSC had requested the assessing officer to issue 131 notice, but no such notice was issued. The crucial fact also the SSC submitted that this loan has been taken and subsequently this loan has been also repaid to these parties through banking channel. The SSC also produced the bank certificate showing that yes, these amounts have been remitted from the account of the SSC and remitted to an account of that particular party. All this was given and say once the repayment has been done, cross-examination has been denied, and the SSC has produced all these documentary evidence merely because some investigation report has pointed out that those parties have indulged in some dubious transaction. all the transaction cannot be treated with the same color and it cannot be added in the hands of the SSC. The SSC referred to certain decisions of Bombay High Court in the case of HR Mehta, Gujarat High Court in the case of Ambe Trade Corp, and made a plea that look, this is a case where repayment has been done subsequently. And because once the repayment has been done, one cannot say that the parties are also not in existence. The parties are in existence. Cross-examination has not been denied. SSC has produced all these documents, and therefore, merely because some investigation report is there, which is in general in nature, not pointing out anything directly against the SSC, the addition cannot be sustained. The tribunal accepted the plea of the SSC and deleted this addition on the ground that nothing has been brought on record by the department to refute the arguments of the SSC. More so, no cross-examination, etc. has been done. The transaction has been proved to be genuine, and the subsequent act of repayment also establishes the case of the SSC. So, based on these facts, coupled with the fact that cross-examination is not been given, the SSC had produced the necessary banking documents showing repayment. The court has come to this conclusion. A good decision in context to section 68. One can refer where the facts are similar, more particularly what has weighed in the favor of the SSC. In this case, what I see is the subsequent repayment coupled with the fact of the bank certificates which were produced to show the bank transaction which has happened, and not merely the SSC rested just by producing the bank statement. He has gone further and got the necessary bank certificate showing the transfer of funds from the SSC account to that particular account in the name of the loan party. Next decision is in the case of Ramchandra Balchand versus JCIT. A very interesting decision where the assessing officer had disallowed the remuneration paid to the partners on the ground that during some such proceeding, some statement was made by one of the partners stating that the partners do not attend the office on daily basis. Though the statement also referred that the partners do visit and they look into the accounts of the firm. However, the assessing officer, relying on this statement under 132(4), which was made by the SSC, went ahead to make this particular disallowance of remuneration paid to the partner. When the matter came before the tribunal, the SSC took up the first plea of 153A, relying on the Supreme Court decision in the case of Abhishek Biltwell, and said that this is not a subject matter where there was some evidence, document, etc., which was found pursuant to which they can make this disallowance. The tribunal agreed that merely recording of a statement under 132(4) cannot be treated as a incriminating evidence without any support or documents. The court further went ahead and looked into the statement recorded and came to the conclusion that what the SSC has stated, that the particular partner to whom this remuneration has been paid is looking into the accounts of the firm. Merely because the partner was not attending the office on daily basis, it could not be a ground to hold that the particular partner was a sleeping partner and the remuneration can be disallowed. The tribunal on both the counts allowed the case of the SSC and said, yes, on both the counts, the claim should be allowed. So on the legal issue of 153A, also the SSC said this cannot be a subject matter of 153A, as well as on merits, say that it is undisputedly position that the tax, that the remuneration which was paid to the particular partner was for looking into the accounts, and that has been also offered by the particular partner in his return of income. Considering totality, the court allowed this claim of the tribunal allowed the claim of the SSC. So this is also a case, if you will see, very well uh, put up before the court. The fact also that the partners has offered them, the fact about the accounts being maintained, the proof in that regards. So all these facts were very properly put up, and which was appreciated by the tribunal to allow the claim. The next decision is the case of Rano Vora. Now, this is a very interesting decision pertaining to assessment year 16-17. Basically, here the issue which was arising before the tribunal was disallowance made by the AO of on account of short-term capital loss on sale of shares of Messrs. Mindtree Limited. The assessing officer had treated this transaction as a colorable device to reduce its tax liability. In brief, during the relevant assessment year, the SSC had set off its long-term capital loss which arose on sale of its shares against long-term capital gain derived from sale of another company's shares. What the assessing officer found from the facts of this case is that the SSC had sold certain shares in the month of February 2016, which derived certain long-term capital gain. The SSC had purchased certain other shares of Mindtree Limited between 17th Feb to 4th March 2016. Whereas they sold the very same shares during the period of 9/3/2016 to 31/3/2016. In the month of March itself, they sold this share. On verification, there was found that on January 2016, there was an issue of bonus shares in the ratio of 1:1. The issue of bonus shares resulted in issue of bonus. The price of share was almost reduced to half of this original price. According to the assessing officer, taking advantage of such reduction in price of shares, the SSC sold the shares purchased earlier, resulting in the short-term capital loss. And by this, the capital gain which had arisen, the SSC had set off. That was the case of the department. According to the department, this transaction, the way the SSC has entered, was a colorable device merely in order to avoid payment of capital gain. The SSC has set off the gain against the short-term capital loss. And therefore, he concluded that this is an unfair means adopted by the SSC to reduce its tax liability on account of capital gain. The tribunal, after considering all this, came to the fact that there was no dispute that during the year the SSC had sold and certain share and arrived at certain long-term capital gain. There is also not dispute that there was SSC has sold the shares of another company wherein there was a capital loss. Merely the assessing officer neither dispute this fact nor has disputed the genuineness of acquisition of shares nor disputed the genuineness of sale of shares. The assessing officer is merely upset with the question of set off what the SSC has claimed, that is long-term capital loss set off against the long-term capital gain. The allegation of the assessing officer, what has been made, cannot ultimately come to a conclusion that SSC has adopted any colorable device for the purpose of avoiding any tax. The tribunal, after referring to the transaction, observed that when the transaction relating to purchase and sale of shares are beyond doubt and are not in the nature of sham transaction, even there is no such allegation by the assessing officer, the short-term capital loss derived by the SSE from sale of share cannot be prevented from being set off against long-term capital gain by alleging adoption of colorable device. There is no requirement under the law that SSE has to pay more taxes. If the SSE arranges the affair within the legal framework and through legitimate means to reduce its tax liability, the assessing officer cannot prevent from doing so. So, more so when the assessing officer has not expressed any doubt or dispute regarding nature of loss being a capital. So, with this observation, the Honorable Tribunal allowed the appeal of the SSE. So, this is a very good case where the transaction which are within the four corners of law and the assessing officer has not doubted the transaction itself, merely the assessing officer is upset with the fact of what has been set off and the timing of the set off which has arisen. That cannot be alleged to be said that it is a colorable device in order to evade some taxes or avoid payment of taxes. And the good observations which are made in paragraph number 8 of this order will be very helpful wherever such type of allegations are raised by the department. I have also referred to certain similar or not exactly similar, but around the same lines of short-term capital loss set off by the different cases, which I have mentioned on the right-hand side last column of my chart. The next decision is of Mukesh Rasiklal Shah. A very interesting decision of Ahmedabad Tribunal, wherein the SSE had claimed certain adjustment under section 57, and the other claim was that the income which the department wants to tax is actually been recovered by the department in the subsequent year, and therefore this cannot be taxed as income. Basically, in short, the facts of the case was that the SSE was involved in some fraudulent activity of claiming refund from the income tax department by some forged challans and other documents. Subsequent investigation revealed that this amount was taken by the SSE, made certain investment in various investment and derived certain income. This, when was discovered an investigation, the funds, whatever could have been recovered, the department recovered that amount. That department also had launched certain prosecution, etc., against the SSE. Ultimately, the assessing officer wanted to tax this particular income in the hands of the SSE, though it was a income which was earned from a illegal source, illegal activities. He wanted to tax. The SSC's defense was that this amount has been recovered subsequently and therefore this cannot be taxed. Without prejudice, the SSC was asking that 57 Roman 3 should be invoked. The SSC also took a plea that it was an illegal income and therefore this should not be taxed at all. Brushing aside all these arguments of the SSC, the tribunal came to the conclusion that the obtained or an illegal income is taxable and is well settled principle of law. Illegality of source does not absolve the recipient from the tax liability. The tribunal referred to the decision of CIT versus Pyara Singh 124 ITR 40 and extensively dealt with this issue of illegal taint money which is derived by any particular SSE and how this amount is taxable. The court also referred to the decision of another Supreme Court decision of Surji Vallabh Das, and wherein the Supreme Court emphasized that income is taxable when it is received or accrued. Any subsequent adjustment do not affect its original taxability. A very good decision wherein the old concept, basic concept of taxation law has been dealt in this decision, a very detailed decision But these are the few very catch point which is there in this decision, which is very attractive, and one should read to have this clear concept of taxability of income and accruable of this income, which is dealt in this decision. The court also referred to the decision of S.C. Kothari, 82 ITR 794 of Supreme Court, where it was held that losses from illegal activities can be deducted only if incurred for earning taxable income. In present case, recovery or repayment of fraudulent income does not qualify as an allowable expenses, and therefore the plea of the SSE in regards to 57 was also rejected. The tribunal observed that allowing deduction for recovery of fraudulent income would contradict the legislative intent of the Income Tax Act. It would effectively permit the SSE to benefit from their wrongful act by reducing their tax liability in subsequent years. So, considering all this, the court also referred to the provision of 2 subsection 24, which is an inclusive definition and does not differentiate between legality or illegality of earning of income. So, considering all this, the court rejected the plea of the SSE. They also rejected the claim of the SSE for a adjustment under for a deduction under section 57, and the came to the conclusion that restitution does not meet the criteria for the purpose of 57. Allowing deduction for restitution of fraudulent earned income would undermine the public policy by creating an incentive to commit fraud. The court, after referring, had rejected the plea of the SSE. Ahmedabad tribunal decision on this very good decision. I have referred to the other decision, which one can go through it extensively. Another decision of of Karnataka High Court, where the SLP has been dismissed by the Supreme Court. Here, the claim of allowability of software development expenses, where the SSE was involved in development for advertisement purpose, and due to change in time and period, the SSE had claimed this software development platform expenses as a revenue expenditure under section 37. The case of the department was that this is enduring benefit which the SSE is deriving, and therefore the same should be in the nature of capital expenditure. The Karnataka High Court, referring to the development in regards to the software, said that where the SSE company incurred the expenditure on development of software for advertisement, but due to rapid change in technology, said application became obsolete and SSE abandoned further development of the said software. Impugned expenditure incurred by the SSE was to be allowed as a revenue expenditure. The SLP also against this has been dismissed by the Supreme Court. So in this, the Supreme Court also confirms the decision of the Karnataka High Court. The next decision is in the case of Deepak. I have some further time for further 10, 15
Yeah,
minutes.
I think you can take maximum 10 minutes.
Okay, yeah.
So then you can complete it.
Yes, I will try to touch upon this. Yeah. Thank you. The next decision is in regards to foreign tax credit claim, which the SSE had missed originally to claim in his return, but subsequently it raised this claim. There was an issue before the tribunal regard the allowing the credit of this foreign tax in regards to the income what was declared by the SSE. The claim of the department was that this credit can be claimed only in regards to the income that has been offered by the SSE in the particular year. When this claim came before the tribunal observed that the foreign tax credit can be claimed even if the corresponding income was reported in different assessment years. The tribunal also observed that the foreign tax credit can be claimed in the year the tax is deducted regardless of when the income is declared. So it is a good ruling in regards to foreign tax credit, and many times this practical difficulty arises in claiming this legitimate tax relief merely because of the income being offered in different years. So a good decision and various other arguments of the department has been rejected by the tribunal. Cornerstone decision, cash credit in regards to share premium. Here the Honorable Supreme Court dismissed the SLP of the department and upheld the Karnataka High Court decision is affirmed as regards to the share premium issue, where the SSC had declared had produced all the necessary evidence in regards to the investors, the fund transfer, identity, creditworthiness, and once these primary evidence was before the lower authorities which had taken a position on this factual aspects, the court said that once all these facts were there and High Court and as well as the tribunal has considered the same, there cannot be any question of law which can be entertained. Also, they dismissed the SLP on the ground of delay, and that is how this particular issue before the of Karnataka High Court can be said to be final. On the same lines, this is another decision of Bombay High Court in regards to cash credit loans. So here the court, in the case of PCIT versus Bairagra Builders, where the court refused to entertain the department appeal, stating that there is no substantial question of law as the factual aspects of the loan, unsecured loan which was there, has been looked into by the two authorities, CIT appeals as well as the tribunal, who have given a concurrent finding of facts about the primary evidence which was there before the authorities, and they have found that the loans are genuine. The loans which were taken has been repaid through banking channel, and therefore merely because some statement was recorded and some investigation has been done, that cannot alone be the reason to doubt this loan and make a disallowance. These being a factual question which has been dealt by the lower authorities, the court was not inclined to entertain the appeal of the department before the Honorable Bombay High Court. I have extensively dealt with the facts, issues, and the other decision. Due to paucity of time, I will just touch upon the main issue of these decision. The next decision is in context to a business loss. Again, Gujarat High Court decision, SLP has been dismissed by the Supreme Court. Again, the department doubted the particular transaction made on basis of investigation by the department, that the script in which the SSC had dealt were not genuine. The SSC had raised various plea before the lower authorities, produced all the documents showing that the transaction were at arm length. It was done through banking channel. The transaction was on the platform of the stock exchange, and therefore merely because some party has given some statement or there were some other investigation being carried out by the department, SSC cannot be saddled with this liability, treating this stock as a penny stock, and the loss cannot be disallowed merely on account of the investigation carried out by the department. The also SSC pointed out there was no direct proof against the SSC or his broker in regards to the particular transaction. The next case is of Sunil Bhatt, Delhi High Court. Again, the SLP has been dismissed by the Supreme Court. Here it is a case basically relating to excess surcharge which was being charged by the department. When the matter reached before the Supreme Court, it was the plea of this before by the SSC that time and again this excess surcharge has been raised by the department, and whenever the SSC comes up before the court the department says that there is a technical default or some technological problem is there, because of which this demand is raised, and thereafter there is a rectification of that. But due to this, there is a huge demand which is created against the SSE. There are wrong adjustments, demand is raised, which is causing problem to the SSE. The court looked into this aspect and observed that in other years also a similar situation has arises in the case of the same SSE, and therefore the court took a strict view, saying that you cannot every time take such type of plea of technological and blame the technology. You should set your house in order. You cannot always adopt such a mechanism and raise the demand on the SSE, and when the SSE reaches the court, then you go and delete the or rectify such demands and orders. So such is not a correct step, and they should take some steps to rectify these problems. The next decision is of Om Vision. We are in the month of January, and recovery notices you must be receiving. A very classic case where the Gujarat High Court had come down heavily on the department, where there were bunch of cases before the Gujarat High Court, and on the earlier occasion, the court had granted ad interim relief to the department till the pendency of the appeal before the CIT appeal. When the matter came up before the court after a few years, the situation was same. The SSC, the court had called the department to file some affidavit stating what are the problems and reasons why the appeals are not being disposed of, and also about the pendency. The court also inquired about the pendency. The affidavit in reply filed by the department, it was revealed that there are total 5,80,188 appeal which were pending as on September 2024. The court inquired how this appeal are being dealt. There was some data which was given that there are how many faceless CIT appeals, there are how many appeals who are non-faceless, JCIT appeals, all this allocation, etc., was explained. The court was not satisfied, and the court also asked them to file a better affidavit explaining what are the steps are being taken to reduce this pendency and how this backlog of cases will be dealt. After repeated reminders, finally, affidavit was filed, which was again not went on very well with the court. And the court said instead of explaining how they will deal with this pendency, they have just given a reason that they have come out with some action plan, Central Action Plan 24-25 and Vivad Se Vishwas scheme. But they have not really dealt how this pendency would be dealt and where the matter has been stuck. Considering this reply of the department, the court said that the department is not interested in resolving this issue. And considering the court finally allowed the petition, stating that the recovery should be stayed, the complete outstanding demand should be stayed till the disposal of the appeal before the authorities wherever the appeals have been pending. Very good decision. However, the decision also highlights the fact that your appeal, which is there, you should file the appeal, make necessary stay application with facts and grounds. It should not be that you file a stay application merely stating that your CIT appeal is pending. Subject to the other facts, yes, this decision is very helpful to the SSC where the recovery are there and the SSC are stuck merely before the CIT appeals as they are not disposing of the appeal. Next decision is on 14A. The issue was about the term annual average, how it has to be interpreted in a case of a situation where the particular investment is not held for 12 months. Instead of 12 months, it is held for 6 months. The assessing officer says that because it was held for 6 months, the calculation should be in accordance with 6 months. The tribunal and the SSC's plea was no, the term annual average is there, and therefore the calculation should always be in regards to the period of 12 months as it talks about the annual average. On this, the court agreed with the submission of the SSC that Rule 8D subsection 2, Roman 2 talks about annual average, and therefore the term annual has to be given as a 12 months, and you cannot reduce it to the period what it was held by the SSE. And therefore, the calculation has to be keeping in context the period of 12 months. Good decision as far as 14A calculation is there. Ground level problems can be explained with the help of this decision. It also refers to a Supreme Court decision where the term annual has been explained in the context of insurance law. The next decision of serial number 21 is in context to prosecution 276CC, where the court have said where merely because late filing of the return, the prosecution was launched under 276CC for late filing of the return. The Madras High Court had not entertained the plea of the SSE and rejected the petition of the SSE. But when the matter was challenged before the Supreme Court allowed the plea of the SSE and quashed the prosecution on the ground that the amount is paid, the return is filed, accepted by the department. There was some penalty proceeding which was also initiated, which also has been dropped. And therefore, in such a situation, there would not be any purpose to go on with the prosecution against the SSE. A very good decision. I have also listed a similar decision where penalty has been deleted. Prosecution proceedings should be put to an end. That may be referred and cited as and when required. With this, thank you, friends, for giving me this opportunity, Deepak, Anil, BCA, and the other organizer. I had to rush through the last few decisions because of paucity of time, but my chart is there, and I will request if it can be circulated also. I have no issue. You can go through this decision at length. As I said in the beginning, please use the decision cautiously, referring to the facts of your case as well as the facts of this case. Yes, the principle of law, whatever has been laid down, can very well apply to different situation, and therefore it is very important that you read the decision before you use. It has always been said that a good lawyer, though it is in a contract, but any representative this court can go, that first he opens up his case, thereafter he explains the facts, the law, and thereafter he opens the heart of the judge. And he does it so beautifully that the judge also doesn't know that what the lawyer is doing. With this, I will end the session, and I will give the proceedings to the organizer. Yes.
Thank you so much, Ajay sir. As we draw this seminar, recent decisions on income tax, to a close, it is my honor to deliver the vote of thanks, a task that fortunately doesn't come with any tax implications. I would like to express my heartfelt gratitude to Advocate Ajay Singh sir, for sharing your valuable insights and expertise with us. Decoding income tax judgments can often feel like, we are trying to solve a mystery novel written in another language. But sir, you made it feel like a short story, clear, crisp, and to the point. The way you broke down the technical concepts into practical takeaways has truly enriched our understanding. Webinars like this reminds us of the importance of, staying informed and adapting to the evolving legal landscape. On behalf of the Bombay Chartered Accountant Society, I would like to thank you, sir, for all your time and contribution, and we look forward to hosting more such events in future. Thank you so much, sir.
Thank you. Thank you, everyone.
Thank you, Ajay.
Thank you. I will take a leave.
Yes.
Yes, yes. Sure. Thank you.
Thank you. Bye.